request everybody to please stand for the ICAI motto. Thank you very much. A very warm good afternoon and good evening to one and all present here. I welcome you to the start of the income tax series, which is being conducted by the Direct Tax Committee of the SIRC of ICAI. This is the inaugural program, and today we have with us the very illustrious chief guest, Principal CCIT of Income Tax Tamil Nadu and Puducherry, Mr. Sushil Kumar Ji. We also have our Honorable Chairman of SIRC, the very dynamic Adusmeli Garu. On stage we also have our Regional Council member, K. Jalapati sir. And we also like to welcome our illustrious speakers for the day, Mr. C.A. T.G. Suresh, who is a hero among the CA circles, and Dr. C.A. V. Murali. We have always strived to give the best to the members, and today's program is nothing but that. The Honorable Chief Commissioner has taken time out of his very, very busy schedule to be here with us, interact with the members, and also share his experiences and how he feels and how he interacts with chartered accountants and the society at large. Our dynamic chairman has been very supportive of this initiative, and when he told me that we have to conduct programs for the Direct Tax Committee every Tuesday, he gave me a free rein and gave me complete support, and for that I thank him a lot. I'd also like to extend a cordial welcome for all the income tax officials, delegates who are here, and other CA members who are present here today. At a very short notice, we have done this program. Therefore, I also want to thank the CA Institute staff, the people who have been a great support, who are not here in the front, but who are working in the background. I'd like to extend my thanks to them and gratitude as well. With this, I'd like to conclude my welcoming remarks, and I request the chairman of the SIRC to please share a few words with us.
Good evening, everybody. Today's chief guest of this meeting, Sri Sushil Kumar IRS, Principal Chief Commissioner of Income Tax, Tamil Nadu and Pondicherry, CA Abhishek Murali, Direct Tax Committee Chairman of SIRCF ICAI, my colleague in the Region Council, CA K. Jalapati, Chairman Career Council Committee. Today's speakers, CA T.G. Suresh Garu and Dr. C.A. V. Murali Garu, who is also former CCM. Beloved members, ladies and gentlemen, good afternoon to all of you. I welcome you all to this series of income tax. Today I am here actually to enter into agreement. Today we have, ICA has entered into agreement of MOU with the Education Minister of Tamil Nadu, where 5,000 schools of Tamil Nadu, state and particularly even other aided schools also, where we have entered into agreement to conduct career counseling programs throughout the Tamil Nadu. Today, I can say this is a good day for Southern India Region Council. This is the first step we have taken. First, we have entered into agreement with Tamil Nadu government, and believe me, first we met on 3rd May to the minister along with my colleague in the council, CA K. Jalpati. They are behind us. Today, we have entered into agreement. I particularly place on my record my gratitude to the particular Tamil Nadu government education minister and their even education secretary, CA Pradeep Yadav, and his all colleagues. You know very well, if any MOU has to enter, particularly in government, it takes a lot of time. Here it is totally different, and they have arranged a beautiful press conference where they have, even minister himself clearly informed about what is CA course and what is career counseling, all this. I am deemed privileged to be as chairman SIRC, and we are going to, SIRC wants to enter into this type of career counseling throughout other states also in the coming days. Friends, our institute is entering 70th year on 1/7/2018. You are well aware, institute actually 1/6/1949, this institute formation was signed on 1/6/1949. So on 1/7/2018 we are entering into 17th year. Institute wants to do a lot of programs which I already shared through my newsletter. Coming to today's program, the topics selected are current issues and proactive initiatives of the Income Tax Department, competition of capital gains on sale of shares and immovable properties, art of preparation and presentation of appeals before CIT appeals and Income Tax Appellate Tribunal, taxation of real estate transactions, etc. Sir, Chief Commissioner, I want to bring to your notice, you are well aware that all chartered accountants are doing. We are helping the even department. We are also with the department. We are doing a lot of tax audits. Minorly, just scrutiny is selected only 1 or 2%. We are cooperating with the department. Any chartered accountant, we will only encourage tax planning. We are against for tax evasion. We are with the department all these years. This is only first session. We have another 11 programs which we will be charging a nominal fees. Since this program is the first program to Mr. Abhishek Murali, so we have allowed as a pre-CP program, and he brought total backed by one sponsorship. I wish that the remaining 11 programs will have this type of strength, and I wish him a long success, and I wish you happy learning. Thank you very much.
Now I request the Honorable SIRC Chairman to please honor our chief guest with a shawl. Request the speakers to please come on stage. I request Regional Council member CA K. Jalapati to please honor our chief guest with a small memento. I request the speakers to please come on stage. As the Honorable Chief Guest is present, I request the Chief Guest to please honor the speakers with a shawl.
Yes, we need to facilitate Mr. Abhishek, who has the who played the main role, and we have seen this total hall is filled with people.
Thank you very much. I would now like to introduce our chief guest for the evening, Principal Chief Commissioner of the Income Tax, Tamil Nadu and Puducherry, Mr. Sushil Kumar, IRS. Mr. Sushil Kumar is an IRS officer of the 1983 batch. After undergoing training in NDAT Nagpur, he was posted as an income tax officer in Bihar and Jharkhand region. He worked there in various capacities. He was ADIT investigation in Ranchi from 1989 to 1992 and played a key role in uncovering the very infamous fodder scam in 1992. He He was then promoted as Joint Commissioner of Income Tax and posted at Chennai in the same year. And he was in Chennai for a period of almost 14 years in this time. And during his period, he oversaw the demolition of what was earlier the Vanarpati Palace inside the premises and reconstructed it as the Vanarpati block that we see today. It's a very upmarket and very well maintained part of the income tax. In fact, if you go there, you'll think you're in a different income tax building altogether. And he played a very key role in his time in making sure that this was done. Later, he worked in Kolkata, Mumbai and Hyderabad, where he was elevated as Chief Commissioner of Income Tax in September 2016. He came back to Chennai in June 2017, and the officers and income tax staff at Chennai were so overwhelmed to see him back in the position that he came back in, because he is such a friendly person, whether it is staff, whether it is auditors, whether it is anybody who visits him. He is a very natural go-getter, and the staff are very happy to see him back because he is very famous for his staff-friendly measures. At present, as we have already said, he holds the charges of Principal Chief Commissioner of Income Tax Tamil Nadu and Puducherry, and he is also the Chief Commissioner of Income Tax 1 Chennai. He believes in a data-driven monitoring mechanism, which he has been very successful in implementing and augmenting the tax collections of the region. And we might all be familiar with him. If we were busy in March and we managed to recover a lot of our dues, it is thanks to Sir actually, because of all the notices that he sent. As they say, God heals the patient and the doctor collects the fees. Income tax issues the notice and auditor recovers his fees. With this introduction, I'd like to introduce and please welcome our chief guest to share a few words with us.
Mr. Venkateshwar Rao, SIRC Chairman, Mr. Jalpati, Council Member, Mr. Abhishek, who is coordinator of all these things, and V. Murli, his father. So, very good evening, ladies and gentlemen. It's my privilege to be part of this CPE program. Last year also I came here to address you, and at that time also hall was almost full. So I am very happy to see the packed hall. And before that, I first congratulate you to enter into that MOU with the state government, adding another feather in the cap. See, the CA's community, I always address them as a bridge between departments and the taxpayers. So I always hold them in very high esteem. As Mr. Rao said that they have been always helpful, helping the department. In fact, what is the role of the chartered accountant? You are called chartered accountant means you are regulated by certain procedures and rules, and this is required, and this is under the Act of the Parliament. So it means that the government reposes a lot of confidence and faith in you, and you not only do that bookkeeping, you look at those books, advise not only your clients but also give directions to the economy, to the government, how to frame policies. So your role is very paramount, and even recently the Prime Minister has highlighted in the recently some conference which he addressed in, and he had very high opinion and good words for all of you. See, this income tax department has a vision that though Mr. Murli has given me some subjects, so I may be digressing. I am speaking generally, which is of general interest. Vision is that to bring in progressive taxation, bringing in tax-friendly measures, and ushering in voluntary compliance. So you may notice that in our vision there is no use of expression like enforcement. The main distinction between the vision of IRS in India and the IRS in USA, where enforcement is also one of the ingredients of the part of vision. So we generally believe in the voluntary compliance. And we have been progressing on this front. We have initially being a miniature department contributing a few thousand crores. Now last year we have given more than 10 lakh crores to the government kitty. So see how the department has progressed manifold. And it could not have been possible but for the assistance and help by you all people. So that's why I said that you are a bridge between the taxpayers and the department. But whether everybody sees like that, generally we are seen as enemies, nobody likes, hatred, abuses. Heart of heart, I also don't feel like paying taxes. It's a human instinct. You see, ever since this new government came, a new practice has started in this department. Earlier, nobody was even giving any weightage or importance to the department, frankly speaking. For the first time, we used to have always annual conferences of chief commissioners in Delhi every year. The income tax department will hold separately, the central excise and customs will hold separately. But a new practice commenced that both the revenue departments combined together, and a concept of revenue Rajaswa Jnana Sangam was brought in by Honorable Prime Minister, where he started addressing us, like how I am addressing you, they are inaugurating your CP program. The Rajaswa Jnana Sangam is inaugurated by Honorable Prime Minister. For the past 2 years it has been happening, and the main thing which he highlighted, that you are such a big force, big manpower, but as far as income tax is concerned, what are you doing? Whether you are utilizing your manpower for the public cause, whether your contribution is to what you are expected or what you have potential. You see, as I said that our object is to go for voluntary compliance, encourage that. So our more than 2/3 revenue comes from voluntary compliance, through advance tax payments, through TDS. Referring to that, he said that this 2/3 comes on its own. So what you bring out of your efforts? Initially he started with 5 to 6%. You are a department who contributes only 5-6%. The next year he increased to, you have now become 10%. The purpose of telling him that you are not proving to your potential. Initially it seemed like that really we were not working to our capacity. But later the government also realized that it is not that way. You see, last 2 years, in 16-17 and 17-18, these 2 years have been very eventful year for the revenue departments, particularly income tax. Realizing that the taxpayers or the potential taxpayers won't come on their own and pay taxes, government realized that we have to lure them. First, by certain schemes which we all know, IDS followed by PMGKY. Even these two schemes did not give desired results. As per the latest economic survey, I think the figure put is not more than 25,000 crores. So what is stopping people to come to the tax net? Then this demonetization came. Basically, this demonetization is said to be a tool helping the income tax department to bring more taxpayer into the tax nets. Then followed by last year July launch of GST. Initially all looked like that first basically demonetization failed. It did not give also the desired results. Then GST marred into initial controversy of implementation. This is the first year when things have or are stabilizing. The impact of those two measures are seen. The biggest object of these two measures, demonetization and GST, was to formalize the economy. You see, the biggest sector of the potential tax paying community, they belong to this small business groups, unorganized sector. There is no effective tools how to reach them. For the first time, all money has now come to banking channels. Entire cash has now formalized. Now task given to us is that now look, we have given you entire information. Now why are you sitting? Why not acting? Again the problem came, yes, people have come forward, whatever money now they have put in bank account, but how to go after them? It was also perceived that now department will go each one, everybody, and harass them. That was another handicap for us, how to proceed. Slowly, we also made the government to understand that it is just like that, we cannot go after that. It will be big hue and cry and it will come back to you only. So we started targeting people, categorizing people. First we made themselves to voluntarily come and own up those transactions. That also did not give results. Then late last financial year, we identified people who had made substantial deposits. We sent them notices. In Tamil Nadu last quarter, about 12,000 cases we sent notices where people had deposited more than 20 lakh in the bank account. Total sum put together is some 29,000 crores. That also doesn't look to be very high sum. Still no response. The bad thing came to our mind that it is you people only who are discouraging. But see, these are not that just ready-made formula and ready-made result. You have to see how the people are reacting. The basic thing which I personally found here in Tamil Nadu, which I experimented last time, that there is a big disconnect between the department and the taxpayer. We don't have that outreach. We have very limited manpower, how to explain, how to educate people. They are ready to hear us, listen to us, and also comply with that. It is not like that. In that process only you are referring to that you could recover your outstanding dues also. That was a unique exercise which carried out in, we have massive data which we have been obtaining and keeping in cold storage, various sources. Now only for past 1 year department has started acting on it. It is being acted upon at national level, but locally we wanted to utilize this. We had massive data lying in the systems, not available with us. We gathered all this data from our system directorate we processed, we found that there are more than 16 lakh potential taxpayers which we had identified and which we can target. Now how to approach? It all, because data processing, data collection, data processing, data mining, it all takes a lot of time. I joined here in June, later on took over as Principal Chief Commissioner in September. I hardly had time. So people were surprised why I am calling for all this information. Nowhere in the country people were asking about all these data. After doing all exercise, we could come to implementing stage only in the month of February. The task was how to reach the 16 lakh potential taxpayers. Then we went to this Postmaster General, that we have to not only address individually to these people, we have to print letters and deliver to them, and we had hardly any time. You see, people all blame government machinery and the government agencies that they are slack, slow, demotivated, no interest in performing. I'm just telling you how the Chief Postmaster General came to our rescue. He dedicated people, passed orders, more than 200 persons were deployed. They had some agencies who were printing high-risk documents. They were engaged. Within 7 days, we printed, and within 7 days, all 16 lakh letters were delivered. All this we could conclude only in the first fortnight of March. So we didn't have any tool how to find out whether they have responded to us or not. Okay, we have sent all communication. See, why I am telling you, this is where we could know what was the impact of demonetization, whether it had any desired impact or not. In Tamil Nadu, this e-filing, returns which is filed online, there were only 24 lakh returns last year. We found on 31st March, there were 46 lakh returns filed. A jump of 72% with this exercise. And we had been given very stiff target, because every year Tamil Nadu had been contributing to national kitty, being the top 4th largest revenue collectors in the country. So every year our base used to go up. Everywhere we were growing 14%, 15%. Last year it was about 16%. Even on that, 18% growth rate was given to us to collect. In fact, when I compared in 2015-16 and with the target given for last year, we were asked to collect 60% more than what we collected in 15-16. Whereas Bombay was asked to collect only 20%. So such an uphill task. Still with this help, we could garner more than 9,000 crore extra, though we could not reach 18%, but we could reach 15%, which is very satisfactory. So people say that demonetization had no effect. It did not bring in any revenue. I think whatever additional revenue we got in Tamil Nadu is only because of this effort and because of this. In fact, the regular taxpayers who have been paying advance tax, they were the biggest defaulters this year. We followed them also. For the first time, people would have forgotten about there is a section called 210 where notices can be issued. Many auditors came that we had all forgotten that there is any provision like that. We found 7,000 defaulters of advance tax. We followed them also, but they did not pay. So who paid? These people who had deposited money. in the bank account. So point which I am making that the people are ready to pay taxes, they don't know. In fact, I will tell you two instances of those 260 lakh taxpayers potential tax which we targeted. One person sent me a money order of 3,000 rupees. My PS came running to me, sir, money order has come. Then I said, why have you sent? He didn't know how to pay. I said, okay, no, I cannot pay myself also, I returned the money order. Then what I found, I saw the letter which I had issued to him. I found that there was a TDS of 3,000 rupees. That man thought that he had eaten money from the government, so it is better to pay back. In fact, he had paid that money. So what I am saying that lack of knowledge. Another case, he said, I am retired more than 80 years. Unfortunately, he also got our letter. We could not, because of paucity, we could not identify who were the senior citizens who were in high brackets. He said, please, I have no taxable income. Please at least write back to me saying that I don't have anything to pay so that I can live in peace. So we responded individually, whoever wanted, he responded individually to each and every one. What I am telling that this whole exercise, this GST also, the impact, many people criticize that it all were without preparing beforehand, bringing a lot of burden on compliance, system is not ready, but we are living in a country where unless something is imposed, we don't follow, we don't adopt. This is our Indianness, I can say. Now all those hue and cry have considerably died down. This will have a major impact on direct tax revenue mobilization in time to come. Now, the entire data is now digitized. Still, large chunk of people who don't want to get into this GST net. This government has brought in that reverse tax credit mechanism that has been put on hold this year. Once it comes, even they also be on the radar. So, this was the biggest structural reform in economy or in taxation ever witnessed in this country. And this is going to give a very big boost to revenue mobilization in the country, making our task also very easier. And it has given you a lot of work for you also. You will be thoroughly engaged. Lot of CAs will pass in future. The big opportunities to everyone. So what I wanted to convey basically that in 2000-2001, the revenue collection in India from direct taxes was only 60,000 something. Last year, Tamil Nadu alone collected 68,000. See how manifold increases, but still the tax to GDP ratio is very low. In the economic survey last year economic survey, it was said that out of 100 voters, only 7 persons are paying taxes. That too, the average tax is ₹7 per head. So that gave time and again idea to finance minister to talk in every budget that India is a non-tax compliant country. See the consumption pattern, see how we see others, how they live the life. They compare with number of cars sold, number of foreign visits made, but still how much tax is coming. So there is a general tendency to avoid tax. Mr. Venkateswar Rao told tax planning, there is very thin line of difference now between tax planning, tax evasion and tax avoidance. So here your role becomes very important. These people have to come to you. You are the watchdog of the economy, I can say. Unless you guide them, counsel them, instead of advising them how not to pay, the country is not going to progress. This problem we are facing on a different war front, where slowly the accountants, the chartered accountants have forgotten their role and they have become consultants, advisors. These cross-border transactions where we have really waged a war. The multinationals who are coming, people think that a lot of investments are coming to country. If you displease them, then they will take back. You all remember when this disinvestment started? When Mr. Manmohan Singh was finance minister during Mr. Rajiv Gandhi time. Has anybody taken back the money, you tell me? Has anybody wounded business and gone? I don't want to talk about that offshore transactions or these tax havens and all. But the thing is that all this money, what is coming to India, is again through tax havens, only avoiding taxation in the respective jurisdiction. And in that process, they also want to avoid taxation here. You must have recently heard of one case which has now reached High Court of one multinational. In US, as you know, that the subsidiaries, profit of subsidiaries are not taxed there unless they bring it back, if they are offshore. So one of the companies, we found that they chose the device because profits were piling up. Suddenly one fine morning, 20,000 crores were transferred. They could not have transferred as transfer of profit because they would have suffered high incidence of tax there. The change gave that different color. But who advised? I don't want to name. They realized that this was a wrong advice. If they had decided, they could have fought it through proper appellate forum. They have gone to Advanced Ruling Authority. So that they also have a face saving, because there they had reported this as a different transaction. If they again change the nature of the transaction, then the agencies are very tough. They will be caught very badly. So what I am telling that we are facing the problem there of real tax avoidance, which is again on the advice and consultation of people belonging to your community. So this is big, because if we analyzed how much money has gone out of country. We took data. You all know that everybody who is transferring fund has to report now to board severity. There is a form 15CA. We found that in last 5 years, more than 2,50,000 crores have gone from Tamil Nadu, outside India. Of course, and that money doesn't represent profit or income. But what is the amount of money which is flowing out of country? So we have special attention to that. At what cost it is happening? The poor taxpayers of the country are paying On their taxes, infrastructure is built, this infrastructure is enjoyed, profits are earned and passed on elsewhere without getting taxed. This is where we have the real difficulty. The role of chartered accountants in serving the country is by providing easy access to these people who wants counseling, who wants advice, how to run their affairs, what is the tax which they can correctly and honestly pay. Unless we get this support, department task is very, very difficult. Now, we are virtually almost 100% on voluntary compliance. What are we doing? Not even 2% we are scrutinizing. Even we want to have now a faceless regime. We don't want taxpayers to come to our offices. We have now ushered in that e-assessment. But the problem is that people are not ready to accept. We want to be transparent, but people don't want us to be transparent. This again, I don't know what could be the problem. You see how the e-governance was best done in this department. We all were very infamous of keeping refunds, not issuing refunds in time, delaying assessment, issuing refunds. The best e-governance mechanism was introduced by this department through CPC. Now nobody has any grievance that his refund is delayed. It may be delayed for a few months. 99% of grievance used to be relating to that has now gone. So where is the grievance? Now we want, you don't come to me. Even that it will take time. So our object is to be totally non-intrusive. We don't want people to have one-to-one contact with us. We want them to voluntarily come forward, pay taxes, and live in peace. And here, your role is paramount. You have to help us. By helping those people, you will help the country. Your department has gone many folds, more than 1,000 times revenue we are collecting. Maybe with this assistance, we will be collecting lakh times of revenue with your help. With this, I want to wish you all the best. You have this learning process continuing. You did not know much about direct taxes. There is nothing much to know about direct taxes. I better that you should have this CP program, how to make yourself reachable to the other end, to counsel them, to help them come to the national stream and be a partner in the nation building exercise. Thank you very much.
Thank you, Honorable Sushil Kumarji. It was a very rousing presentation that you shared with us. Our next topic is going to be computation of capital gains on sale of shares and immovable properties. And with us, we have Mr. T.G. Suresh, who is a hero of the masses, a very youthful person. Every year you see him, he's getting younger and younger. And as a matter of fact, his threadbare analysis of the budget at Rani Site Hall and Hindustan Chamber was a super hit. I remember as a student, he was so good at capital gains that we used to actually call him CG Suresh because he was such a good teacher in capital gains. Therefore, I request K. Jodapati, our regional council member, to introduce our next speaker.
So
I want to seek leave from urgent matters to attend. Thank you very much.
Very good evening, members. Our speaker today, CA T.G. Suresh, is well-loved and demand faculty in taxation in South India. A brilliant and excellent academician, he is a chartered accountant, cost accountant and company secretary. He is in active practice for the last 2 decades and he has been faculty in taxation for 25 years as well. He is a visiting faculty with ICWA and ICSI institutes and for various branches of SIRC of ICI. His clarity of thought and excellent presentation of the subject have earned him a mass student following, and he is also a speaker who can unravel the mysteries of the topic in a clear-cut manner and small wonder them. He is called upon to speak on various topics of taxation in professional fora and to present papers and lead discussions and workshops. He has authored 2 books for CA students covering the IPCC and final syllabus comprehensively. Soft-spoken and a nice gentleman. CA T.G. Suresh has the right blend of academics and professionalism to make him a winner in both the circles. Yes, he is a good demystifying complicated issues concerning taxation. We have asked him to give detailed presentation on computation of capital gains on sale of shares and immovable properties. Please give him a big hand over to CA T.G. Suresh. Thank you.
Good evening, everyone. So I must thank both Abhishek and Chalapati for those kind words. In fact, especially the word relating to younger every day. So that always sometimes, like whether you look beautiful or not, if somebody comes back and you romba alaga irukana, then you'll just a feeling, no, that's why. Similarly, you super பாடுற பாத்ரூம்ல நம்மளாலே கேட்க முடியாது, but still people who have this very strength, so there are some few things makes us happy. But one thing is sure, I think my profile I didn't send. So therefore, I think this should be a 1 decade before profile because now I'm 30 years now, so of experience. So is it 2 decades? So unless there is either you missed out the 10 years or the profile definitely I have not sent today. So therefore, I think if I stand corrected. Therefore, to that extent, it gives you a feeling that I'm a little bit more younger than the age submits. I'm pretty happy about that also. So, you ready for them? So broadly what I've done is that if time permitting, I'll start with 2 issues on capital gains, which will be the issues of the future, definitely not going to be the current issue. Then 45(5)(a) is going to be even more a futuristic issue because the section just came recently. And also another new section 112(a). So these are the issues which I have planned subject to the availability of time. Because I have a feeling by first 2 issues itself could take some considerable length of time. So at any point of time, definitely instead of waiting for the question session to be at the end, maybe as and when you can always stop and then get clarified. So for any issues, so that you don't have to wait till the last minute. This issue is more related in the sense like when we take a 45(5)(a), possibly this issue could be of some relevance as well. So basically the broad issue here is that I have purchased a land which is more than 3 years, on which I constructed the building. So I sold the building along with the land. So the building was less than 24 months because of the amended definition of 242. It's no longer 36 months, now 24 months. But the land is more than 24 months, it's become long term. And the building is less than 24 months, is short term. So I am selling the building along with the land. You can assume that to be a residential house. So a building is a residential building. So basically the assessee wants to offer the income as a long-term capital gains by taking the sale as the land, this building as a cost of improvement. Now from the point of view of the income tax department, if both are long-term, you are saying you have only sold a house. So therefore the entire capital gains should be offered only as a short-term capital gains. So because when you are selling both are long-term, you only take sale as a house. But when your house is short-term and land is long-term, so therefore assessee is trying to offer both as a long-term by taking the house as an improvement or the building to the improvement to the land. So broadly the issue here is that what is the nature of capital gains? Should it be short-term? Should it be a long-term? That's the first issue. And once we conclude this issue, the next issue is that if he reinvests in a residential house, is he eligible for exemption? If yes, the exemption is going to be under section 54 or is it going to be under section 54A? Because basically section 54 is available for sale of residential house which is reinvested in a residential house. Whereas 54F is available if you transfer any capital asset other than residential house if you invest in a residential house. So and both are available only for long term. So this is basically the issue, this issue I'm going to use it at the time of discussion of 45(5)(a), where this issue could be of lot of relevance, especially after the Karnataka High Court judgment, so which will have a huge implications as such, unless there is an amendment is carried out in either of the sections. So now in this particular case, what is the nature of capital gains? So we have to go back to one of the earliest decisions was put in 1960s, so where the assessee constructed a theatre and claimed depreciation on the entire theatre building. And the assessee's claim was I should be given depreciation both on the cost of the building as well as the cost of the land, because according to him, after the construction of the theatre, the superstructure, land as a separate does not exist. Therefore, I should get depreciation the full. The Supreme Court got furious about this particular point. It said, demolish your theatre, you will find the building, find the land. So therefore, it is not visible, that's all. So land as a separate asset continues even after the superstructure. So therefore, you will be entitled to claim depreciation only on the cost of the building. And land as a separate asset even after the superstructure is long back recognized by the Supreme Court. So based on this, there are a lot of decisions across the country. So when your land is long term, building is short term, then the land will be computed as a long term capital gains and the building will be computed as a short term capital gains. So then the department objection in this particular case says there is no bifurcation available. We would have accepted this particular point, provided the assessee has bifurcated the sale consideration separately for land, separately for building. Now he is saying that he has sold the residential house for an X amount without bifurcating the consideration into land and building, for which the courts themselves gave a solution. In any case, there is a bifurcation needed for stamp valuation or stamp duty purposes. Therefore, if there is a separate consideration is not there also, you split the consideration according to the guideline value or stamp valuation. So therefore, even if the consideration is composite, even if the consideration is not bifurcated, you can split the consideration as per the stamp valuation. For land will be separately considered as long term, building will be considered as a short term in the event of land being more than 24 months and building being less than 24 months. Therefore, to that extent, by and large, you will not be in a position to find any dissenting judgment anywhere in India. So most of the courts are fairly in agreement with this particular point. Even if it is a single sale or with a single consideration, if land is long term, building is short term, you can bifurcate the capital gain separately. Now, since the building becomes a short term capital gain, so the reinvestment is done in a residential house, the department's very interesting contention was the exemption should be available here under 54F, because the capital gains to the extent of land alone is long term, building is short term. Land in a residential house will get exemption only under 54F. Only a residential house in residential house will get exemption under 54. Again, the most important point of distinction between 54 and 54F. In the case of 54F, you have to put the net consideration. Whereas in 54F, it is sufficient you put only the capital gains. So therefore there is a larger amount of investment is required to claim exemption to 54F, apart from which you have some host of other conditions in 54F, where you should not own more than one residential house, you should not purchase more than one residential house, you cannot construct more than one residential house. So 54F contains more conditions, and the amount you need to investigate exemption is also more. Therefore it's convenient if it's possible. I would always like to throw the exemption under 54F rather than 54, where the amount required to be invested is only on the capital gains factor. This also prompted the department to take a stand. See, even assuming that we accept the contention that the land is long term and building is short term, the exemption should be given only under 54F, because capital gains exemption is not available for short term. Only the land portion of it is long term, therefore the exemption should be given only under 54F. This is backdrop on this issue. And this issue, as I said, will be of substantial relevance when we move to 45(5)(a), which is a newly introduced section from the last year. So to understand this particular point, just for the benefit of understanding, we'll briefly touch what is section 54, it's just taken from the Income Tax Act. Now, if the capital gains arises to an individual from the transfer of a long-term capital asset, being a buildings or lands appertained thereto, and being a residential house, the income of which is chargeable tax on the ISB. Now, this portion of it is enough for us. To claim exemption to 54F, it must be a long-term capital asset, it must be being a buildings or lands appertained thereto, and being a residential house, in the income of which is chargeable tax on the house power. So, you have to reinvest in one residential house in India. Now, let's go to 54F in this regard. So, subject to the provisions of subsection 4, where in the case of an assessee being an individual or insured, the capital gains arises from a transfer of a long-term capital asset, not being a residential house. I think we can stop at this point in time. The transferred asset for the purpose of section 54F has to be a long-term capital asset, not being a residential house. Now take the example I have taken. I have purchased a plot of land. In that I have constructed a residential building. Then I am selling the residential building along with the lands appertained thereto, which is a residential house. Now the only thing what happens in this particular case, I have sold the asset, one is long term, one is short term, but I have not sold it separately. What I have sold is only the residential house. The only part of it is my superstructure was held for less than 24 months, my land was held for more than 36 months. There is a need to bifurcate the capital gains into two, but I only sold a residential house through a single document. So therefore on a plain reading of section 54F, it will appear, the section says to apply section 54F, the transferred asset should not be a residential house. Did I transfer a residential house? The answer is yes. I did not transfer land separately, building separately. I transferred only a residential house. So therefore straight away 54F is actually not applicable to me at all, because what I have transferred is only a residential house. So surely 54F is not applicable. The only contention now is 54 will it apply. Whereas the department took a stand, land is long term, building is short term, land invested in residential house, you should be given 54F. But I have not sold land and building through a separate document. It's only a single document. And that document was only talking about sale of a residential house. Therefore, let us go in 54 and find out whether I'm going to be eligible there. Now, these are the views of the Karnataka High Court, not mine. So, the capital gains arises from a transfer of long-term capital asset, being buildings or lands appurtenant thereto. So, and being a residential house. Did I sell a residential house? The answer is yes. Whether it is a buildings or lands appurtenant thereto, the answer is yes. So what I sold is buildings along with the lands appurtenant thereto. Am I eligible for exemption to 54 for the buildings portion of it? The answer is no, because at the beginning of the section, it's very clear section, the capital gain should arise on account of a long-term capital asset. To that extent of the building, it is not a long-term capital asset, it's only a short-term. Therefore, not eligible for the building. Whether the lands appurtenant thereto, is it a long-term capital asset? The answer is yes. Did I sell a residential house? The answer is yes. Whether the income of that is taxing the house property? The answer is yes. Therefore, the citation also are given there. The Karnataka High Court has taken a stand in C.N. Anantharam that exemption in this particular case is available only under 54 and not under 54F. So therefore, when you sell a land as well as a building, if land is long-term, building is a short-term, there is no need to apply the exemption to 54F. The exemption should be given only under 54. So unless there is a specific amendment made to the section, this Karnataka High Court judgment appears to be based on good reason and logic. As you can see from the section, because I am not going to get 54F, because what I transferred is a residential house. Will I get 54? The answer is yes, because the section covers buildings or lands appurtenant thereto. So this judgment we are going to use it a little bit later under section 45(5)(a), which is new section. That is why I thought I can have this issue. These issues will definitely will be more frequently in the radar shortly, because the section will come into focus more only now, because there is a modification the provisions of 56(2)(7) only from assessment at 2014-15. Therefore, you have to see more on appeal side of this particular provision only in the future. So therefore, possibly we can take it as an issue of the future, for which a small intention is given by the Karnataka High Court again. So basically here the assessee sold a land for 100 lakhs, the stamp valuation of is 200 lakhs. The indexed cost of acquisition I taken as 80. He purchased a new residential house for 160 lakhs. What is the exemption under 54F and what will be the taxable capital? I just condense the issue. So instead of trying to give it as a big issue. There is an actual consideration of 100 lakhs, stamp valuation of is 200 lakhs. So I have already given the index cost is 80. The new residential house purchased for 160 lakhs. So what will be the exemption under section 54F? What will be the taxable capital gains? Now again, as most of you are aware of, in this particular case, 50C will apply because the stamp valuation is 200 lakhs. The actual consideration is 100 lakhs. Since the stamp valuation exceeds the actual consideration, the stamp valuation is going to become the deemed full value of consideration for the purpose of 50C. So the capital gains therefore will be computed like this: 200 lakhs is the stamp valuation, the index cost is 80, so the capital gains is going to be 120 lakhs. So I will make a small modification to the cost of the new residential house just to give a better implication of this discussion. So I'll take the cost of the new residential house as 100 lakhs just to get that. I just slightly modified, we'll just go back to the example of 1/6 a little bit later, just to give the perspective here. A new residential house purchased for 100 lakhs, what is the exemption under 54F? Now 200 lakhs is my stamp valuation, 80 lakhs is my index cost, my long-term capital is 120 lakhs. Now under section 54F, the exemption is going to be proportionate. So now the question is, what is your numerator? What is your denominator? Into what? Into is not a problem. The capital gains is going to be 200 minus 80, 120. Now what is the numerator? Now assessee has purchased a new residential house for 100 lakhs. That is the numerator. Now what is the denominator? Now when it comes a question of denominator here, should I have to take it as 200 lakhs, which is a consideration as per section 50C, or should I have to take the amount as 100 lakhs, which is the actual consideration? Now this is broadly the issue. So 50C says when your stamp valuation exceeds actual consideration, stamp valuation becomes a deemed consideration. So since the exemption is going to be proportionate, what I should use as the numerator and the denominator? Numerator is not an issue, I purchased for 100 lakhs. Denominator, department obviously tried to apply it as 200 lakhs because the stamp valuation is the consideration. Take it as a 200 lakhs. So into the capital gains, therefore you take the capital gains as 120, therefore the exemption is going to be 60 lakhs. A very simple working. But when you go to section 54F, now this is how 54F defines the net consideration. The amount invested in the new residential house divided by net consideration into capital gains. Now the net consideration in relation to a transfer of a capital asset means the full value of consideration received or accruing as a result of the transfer of the capital asset as reduced by expenditure incurred wholly in connection with such transfer. Now, what is the full value of consideration now? Because this is the definition which is there for 54F. It's full value of consideration minus expenses. So let's assume expenses has to be 0. So should I have to take 200 lakhs being the 50C consideration? Because if you look 50C, if the stamp valuation exceeds the actual consideration, the language of 50C is very clear. For the purposes of computation of capital gains under section 48, for computation of 48, this shall be deemed as full value of consideration. Now broadly the issue here is that can I superimpose a section which is a deeming section where it mentions only section 48 to 54 series also? Or should I have to confine it for the computation only, and for exemption should I have to go by a consideration other than 50C? Or if there is no 50C, the example which I have taken, the consideration is only going to be 100 lakhs. 50C, as all of you bear of, is introduced only from assessment year 2003-4. Prior to assessment year 2003-4, there is no 50C. If there is no 50C, the amount is not going to be 200 minus 80. It's only going to be 100 minus 80. Now there is a fiction which is created by 50C. Now is that fiction trying to talk about notwithstanding anything contained anywhere in capital gains chapter? The answer is no. Is section talks about notwithstanding anything contained in the act? The answer is no. It only says for the purpose of computation of capital gains under section 48, for the purpose of computation, that shall be deemed to be the full value of consideration. Therefore, such a deeming provision can I extend it to 54F. That is broadly the issue. Obviously, the department contention is 50C should also be imposed into 54F also. Obviously, the assessee will come back and say, no, that is only for computation. But for the purpose of exemption, I will only go by 100. To substantiate this point, his contention is also, when I have only 100 lakhs of actual consideration, take my example here, the sale consideration is now I have sold a land for 100 lakhs. The money which I have hand is only 100 lakhs. From where can I invest more than 100 lakhs when I have only 100 lakhs of money? So therefore my actual consideration hand is only 100. You cannot ask me to perform something which is impossible to perform. So I have only 100 lakhs, the maximum amount invested. Further to it, the full value of consideration defined as 54F. As you can see from 54F definition of consideration. So full value of consideration minus expenses, not as full value of consideration. Is it actual consideration or should it be a 50C amount? For which you have to go to 50C. In 50C, stamp valuation shall be deemed only for 48. It never talks about for the chapter or for the act. So therefore the stand which is taken, I will take computation on the basis of 200, but when it comes to question of exemption, I will take it as 100. This is what the SSC's contention. So he has also in this connection a support from a tribunal judgment also. That's how I worked out that Prakash Karanwar case, where it's a very interesting decision by the tribunal. It says 200 minus 80, 120. So you should have invested only the actual consideration of 100. Since you have invested the entire actual consideration, then 45 uses the word the entire amount is exempt from tax. Once your investment is more than or equal to the net consideration, entire capital gains is exempt from tax. Now what is that consideration? It's only 100 lakhs as per this tribunal judgment, and as a result of it, entire capital gains will be exempt from tax. And what should be shocking the department here? In a proportionate exemption section of 54F, see 54F is a proportionate exemption section. In a proportionate exemption section, look at the amount of exemption. For 100 lakhs of investment, he gets 120 lakhs of exemption. I don't think any one of us would imagine 54F is going to provide for a weighted exemption. It's now becoming like 35 2AB. So which is a shock. There's no doubt about it. When you just look at dispassionately, and this treatment of the tribunal puts the quantum of exemption as more than the amount of investment under a proportionate exemption section. It's not even in 54. We are talking about 54F. It's supposed to give a proportionate exemption. You end up in getting a weighted exemption. Therefore, when you take 100 lakhs as a number, possibility is possible for you to appreciate why the department has got every reason to be apprehensive about this treatment by the assessing, because of the fact that this gives them more exemption than what they've invested. So therefore, obviously, they would like to take a stand. The proportion of 50C should also be incorporated into 54F also. So therefore, to that extent, there is a bit of a logic in the contention. Therefore, what you have to do is, you should also consider whatever amount which has been considered as a consideration for 50C. Now, this view has also been accepted by the Karnataka High Court judgment. So they did not accept the tribunal judgment. So the judgment which I have shown there, so Gauli Mahadevappa. So what they said that the 50C should also be implied into 54F also. You also put 50C into 54F. Therefore, for the purpose of exemption, denominator should be considered as 200 lakhs only, which is nothing but the full value of consideration for the purpose of 50C should also be superimposed into 54F. So to that extent, denominator is not the problem. Now, I'll once again go back and change the cost of the residential house now for a better understanding. Now I'll just go back to my number which I have taken originally, which is 160 lakhs. And I'm going back to 160 once again. The reason for me going back to 160, then the department made a very interesting pitch on the numerator side of it. Denominator is 200, numerator they said has to be 100. The reason for department taking a stand that the numerator has got to be 100, that is the maximum amount you have from the capital gains. You got only 100 lakhs. 200 lakhs the stamp valuation is your deemed consideration. You have only 100 lakhs of money. How you could have invested more than 100 lakhs? How you could have invested? That amount should have come from either a loan or from your some other saving. It could not have come from sale of this asset. Now from the sale of this asset, the number you have or the amount you have is only 100 lakhs. Therefore, the cost of the amount invested in the residential house, even though you have put 160, that is one of the reasons why I just went back to 160 number. So 100 I gave only to appreciate this particular point, and inadvertently 54F leads to a weighted exemption. So therefore, I would just want to take the number, but this 160 could be the more appropriate number from the Karnataka High Court judgment point of view. So the department stand was take the numerator as 100, take the denominator as 200 into capital gains. So 100 by 200 into capital gains, the exemption will be only 40 lakhs. Denominator, I go by 50C. Numerator, I will not take the full cost of your investment because you had only an actual consideration of 100, which they did not accept for the denominator because that's the maximum I had for the denominator. But for denominator, 50C will be taken. For the numerator, as you have only 100 lakhs of money, you could not have invested more than 100 lakhs other than through a loan or any other method. It could not have come from the sale process. Therefore, the numerator should be taken as 100. Fortunately or unfortunately, the Karnataka High Court did not accept this view. It said the moment you want to put the denominator as 200, boss, you cannot say the numerator has got to be only 100. So therefore, the assessee should be in such circumstances to reduce the capital gain tax, should be allowed to invest either from his savings or from his loan. And nowhere in the Act, if you read 54 or 54 any number of times, you will not find the section saying the investment has to come from capital gains. There is no requirement in section. Already decided by the Kerala High Court in KC Gopal. There is no requirement in the section. It never says out of the capital gains you should invest. It's not there at all. These two are independent transactions. One is the sale of a house, other one is the investment. One is the sale of any other than residential house, put in the residential house. And from that sale process is not there at all. Now again, you can take also a lot of examples to support this particular point. 54 and 54 are not only available for sale, they are available for transfer. So let us take a very simple case. So me and Subramani exchange on property. And for a very strange coincidence, the value of the property exchanged with both of us is same. Let's assume it's 1 crore each. That means there is no cash component is going to pass between me and Subramani. Now the capital gains is going to be covered on the basis of fair market value of assets I received minus my cost. The same working for him. But if we have to claim exemption with no cash component passing, how are we going to invest? We have to only take some loan or two out of our savings. These are the examples given by various tribunals and court to justify to the conclusion that there is no need for you to put the money out of the capital gains. So long as you have a capital gains, as long as the investment, if other conditions satisfied, give the exemption. With view has also been accepted by the Karnataka High Court in the case of Gauli Mahadevappa. So therefore, in this particular case, they said numerator has to be taken as whatever amount invested by the SSC. Denominator has to be considered as 50C value into capital gains. So the working also I have shared as to how the working has to be done as per the Karnataka High Court judgment. If the tribunal judgment, which is Jaipur bench of tribunal, so we have to find out how Rajasthan High Court is going to take a stand there. So if that judgment of the tribunal is followed by some other court, you will file for 100 lakhs of investment. That means you should invest only the actual consideration. If you do that, you get full exemption. It could result in exemption being even more than what you've invested. But the Gauli Mahadevappa judgment, in my view, appears to be more logical and rational than the tribunal judgment. If you 160 is nothing but the total amount invested, even though 100 lakhs is the actual consideration, remaining 6 lakhs can come from somewhere. That 160 is the numerator, denominator is the 50C amount into 120, which is the capital gains. Therefore, you will get an exemption of 96. That means if the assessee puts the entire 200 lakhs, 100 lakhs out of the sale process and 100 lakhs out of some other source like loan, he can still make his capital gains zero as per the Karnataka High Court judgment. So the most important point which the Karnataka tries to throw here is that investment need not have to come from the sale process. It can be from loan or any other source also, which is the most crucial point. Apart from it, they also seem to be conceding the fact that 50C denominator can be used for the purpose, notwithstanding the fact 50C says only for the purpose of computation of 48. They conceded the fact that 50C has to be applied in 54F also, which is a major decision. But what you must all bear in mind, when this case law came, just for the recollection of this particular provision, from 1st October 2009, a section introduces 5627, which as on the state stands is 56210. So 5627 came into effect on 1st October 2009, where an immovable property and movable property is also going to be subject to income from other source. Now under 5627, for your recollection, from 1st October 2009 to 31st March 2013, the provisions of 5627 does not apply for inadequate consideration of a sale of an immovable property. The logic is pretty simple. If, take this example itself, the seller has paid capital gains tax on 200 lakhs, even though his actual consideration is only 100 lakhs. Now, since we are already taxing the seller, instead of a capital gains tax of 20 lakhs, he has already been subject to tax on 120 lakhs, which is 100 lakhs more than what he has received. Had there been no 50C, the capital gains would have been only 100 minus 80, 20 lakhs. Because of the fact that stamp valuation is adopted and 200 lakhs is taken, already seller has paid a capital gains on 100 lakhs amount which he has not received. Therefore, the lawmakers consciously, in my view, from 1st October 2009 to 31st March 2013, kept outside the purview of 5627 or income from other sources, transfer of land or building for an inadequate consideration. Now, if the consideration is there, even it is inadequate, the provisions of 5627 does not apply at all. Unfortunately, from 1/4/2013, 5627 was specifically amended to provide if it is inadequate consideration. For this purpose, inadequate consideration is nothing but the stamp valuation minus actual consideration. If it exceeds 50,000 rupees, then the difference shall be taxable in the hands of the buyer also as income from other source. Now, what is very unfortunate and strange in this particular point is that for the same transaction, both buyer and seller both are going to be taxed. So, buyer is going to pay tax 100 lakhs of income from other sources. Sellers also paid 100 lakhs of excess capital gains which he has not received. Therefore, it's very, very unfortunate and pretty strange that why a same transaction is getting taxed in the hands of both the person. In fact, this particular budget, at this point in time when the budget presented, the finance minister also mentioned this particular point. I was about to clap him for what I thought is going to make a change in the law, is that these transactions are getting taxed both in the hands of buyer and seller. I thought finally they're going to make a change, and then he came back and said to avoid this, I'm going to give a 5% deviation in 50C and 56(2). So from assessment in 1920, suppose if your stamp valuation is 105 lakhs and your actual consideration is 100 lakhs, then that 5 lakhs, we're going to ignore it. That means you're not going to be subject to 50C at all. But what started off with a nice speech, but unfortunately we're back to the same thing, only thing that 5% deviation is accepted in 56(2), in 43CE and also in 50C. But possibly the better understanding could have been either only one person should have been taxed here, either the buyer or the seller. You can't have the same transaction, both the person getting taxed. Having said this, what they are trying to come back and say, even though you're paying taxes 100 lakhs of income from other sources, that 100 lakhs, you can take it as a cost of acquisition under section 49 subsection 4. So therefore the actual cost of 100 lakhs is not going to be the cost in the case of the buyer, even though he's paid 100 lakhs. Since the stamp valuation is 200 lakhs, whatever amount he has paid, he can take it as a part of actual cost. So therefore, just coming back to this particular point, the investment point, he purchased a new residential house for 106 lakhs. Just to ensure that all of us are in sync with this particular point, as per the Karnataka High Court judgment, numerator is 160, denominator is 200 into 80. But in that particular example, what I have not given, which I am going to introduce now, in continuation of that example, let's assume in this particular case, the stamp valuation is 180 lakhs. I purchased a house for 160, whereas the stamp valuation of this is 180. Now, this information Karnataka High Court could not have handled for a very simple reason. When this judgment came, as you could have seen from the judgment, this 2013 judgment, so it is impossible for you to have 56(2)(7) been applicable in a 2013 High Court judgment. All of you know it. I don't have an article. So, because the provision of 56(2)(7) been applicable for net required consideration itself came on assessment of 1415, and by the time the judgment itself was delivered, even the judges will have no opportunity to even know there is going to be an amendment in the section. Therefore, there is no chance of Karnataka handling this issue. Now, the point here is that in this particular case, the new resident plus 106 lakhs, the stamp valuation is 180 lakhs. The buyer is subject to income from other sources of 180 minus 160 is going to pay 20 lakhs of income from other sources. The moment he pays 20 lakhs as income from other sources, then 49(4) becomes applicable. Now, 49(4), which I have also reproduced for your easy reference. So, where the capital gains arrested from the transfer of property, the value of which is subject to tax under 6(7)(7)(e), or maybe you can also add 56(2)(10), the cost of acquisition of such property shall be deemed to be the value which has been taken into account. So, what is the value which you have taken into account for the purpose of 56(2)(7) is 180. Because that 180 minus 160 becomes your income from other source. That means 180 being considered for the purpose of income from other sources. Therefore, instead of 160, 180 becomes a deemed cost. Now the important point, when you can take what is the actual consideration, 100, what is the deemed consideration, 200. So in denominator, you can take 200, that is what the Karnataka said. Denominator, don't take actuals, take it as 200. If your denominator can be taken as actual consideration, the deemed consideration of 200, one logical question which you should anticipate in the future is that why not the deemed cost be considered in the numerator? Because you are taking fiction. You cannot have a situation where the numerator pays actuals, denominator take deemed. So either it should be deemed or actuals. Yeah, there cannot be a double standard where I will take 160 in the numerator being the actual cost and the denominator take deemed value. See, 49(4) and 50C you have to link. This is, we call it as popularly interplay between 56(2)(7), 49(4), 50C. So therefore, applying this particular logic, possibly, I've just tried to work out what could be the scenario. So this is how the exemption should have been worked out, 180 by 200 to 120. So the amount should be 108 and not 96, which is printed there, because that should be 90% of 120, should be 108 and not 96. So whereas the other judgment, still it goes by the actual consideration. Therefore, there won't be any change in the answer to the tribunal judgment, the Jaipur bench tribunal, that will continue. So long as you put more than 100, according to that judgment, there is no issue. But if I think the Karnataka judgment looks more reasonable, but having said this, don't expect them to handle the issue which is not in their hand. But as a result of it, the logical numerator has got to be 180, which is a deemed cost. Denominator has to be 200, which is a deemed consideration. The moment the department wants to take the numerator as 160, unfortunately, they will also lose in the process. Denominator is 100, not 200. So therefore, that is a trade-off they have to do. What they want. If they want 50C in the denominator, accept 49(4) as the numerator. Because then the courts will not accept this particular point. They will not allow you to take a different numerator and a different denominator. Same thing for the assessee also. Assessee also too has to trade off. What do you want? Both deemed or both actuals? That's a very interesting point. I think the section started only in assessment in 2014-15. And you should expect this issue to crop up shortly, because only when 14-15 at an appeal stage, just now it's going to be there. So I think in the coming days, you will find this is the issue which most of us have to handle. So very interesting issue, nice twist given by the Karnataka judgment. So let's wait and see as to where the matter ends. Maybe before my life comes to an end, maybe Supreme Court will decide this issue. So I'm that much optimistic, but otherwise, So if you have any question on these two issues, maybe we can address this. Yeah, I told already. I told it's a simple. When you duplicate a set, there's a problem. No, I didn't do any copy paste. I made only duplicate set only. So only one change I made. That number was not changed. I think it's the institute slogan. We can take substance old form. So I think I already made a point. That the number should be 108, but I just missed it out. That's all. But other than that, apart from the number, if you have any specific issues, if you have, or you just want to, yes, sir.
49.4 will be useful only when you sell a property already suffered 56%.
Yes, sir.
49.4 will become useful only when you sell a property that has already suffered 56%. So, if we had purchased the property in 2000, selling it will not come to your hand.
No, so I think basically my intention is not to when this issue will come. So in that particular case, we may have to go to 49.1 in those circumstances. The corresponding issues relating to 49.1.
The benefit of 49.4 is about time.
No, I'm not saying there is any benefit. In fact, we have to restore it.
Because already, see, the time between the introduction of PC, you will only suffer. You cannot take the benefit of 49.4 because 49.4 came into effect very recently. And because of 2013 amendment, 5627 has come into place. Then the sale of such properties will take some more time. So for earlier purchase of property that was purchased earlier to 2013, naturally it would not have suffered 5627. So benefit could not be avoided.
See, so that is the benefit here. That's what I'm saying. See, there is no benefit at all. Already, it's something which should not be taxed, already been taxed. So therefore, I'm not able to understand your point as to why there is a benefit. It's not, in fact, 49.4 itself should have been given as an optional one, because 49.4 by itself is not the section which should have been there on the basis of an equity, because you are trying to bring the same transaction tax in the hands of both the persons.
Yes.
So therefore, the question of 49
is 49.4 has brought into force, mitigate the suffering at the time of sale of that property.
Sir, I would definitely beg to differ with you because of the fact that 49.4 being not there, possibly you would have got the benefit of 49.1, because the moment you are going to have it as a 49.1, in most cases you will get, unless, I'm not talking about a situation where you have an actual consideration. Imagine a situation where there is no consideration and it is going to be subject to 5627. The moment you apply 49.4, it is possible to take a stand. The holding period will be considered only from the date of the gift and not from the previous order. Because if you go to come under 49.1, you get the cost of the previous order, you get the long-term benefit, you get the indexation. Therefore, I think that is an altogether different issue. My point is, the point is you take the denominator as a deemed value, take the numerator also. So therefore, I'm not derailed to really advocate whether 49.4 is beneficial, when the benefit is going to accrue or not. The point which I'm trying to drive home here is that the moment you take deeming value in the denominator, put the numerator also deeming value. That's all. Beyond that, so whether it is beneficial or not, I think each SSC has to take a call. So let's not get into that particular point as to whether it's beneficial or no beneficial or when it's going to accrue. The point is that denominator deeming automatically makes the numerator deeming. So that's the point which I was trying to drive home there. So this is another section which came into effect from assessment in 1890. So which is the new section 45(5)(a). So basically, I will just run through, because being a new section, most of us would not have gone through in detail about this section. Therefore, we'll just run through the basic provisions and then take a few issues relating to that and why the section has got to be introduced. Where the capital gains arises to necessity being an individual or HUF from the transfer of a capital asset being land or building or both under a specified agreement. This is what the section says. So what is very important and very interesting is this section is applicable only for individual or HUF. So therefore, even after the introduction of 45(5)(a), any joint development entered into by a person who is not an individual HUF, they will not be covered by 45(5)(a). The scope of the section has been limited to only an individual or HUL. Now, what is a specified agreement which appeared in the previous section? The specified agreement means a registered agreement in which a person owning a land or building or a both agrees to allow another person to develop a real estate project on such land or building or a both in consideration of a share being a land or building or a both in such project, whether with or without payment or what is the payment of consideration. So what is very important is the portion of the consideration has to be in kind to apply 45(5). So the whole consideration is only in cash. 45(5) will not apply. So that means unless you, the landowner or the building owner is going to get the consideration by way of allotment of constructed area for him, the provisions of 45(5) will not apply. So that is very crucial. 2 points which I want to bring to your attention. Section will apply only for individual or HUF. Section will apply only when some portion of the consideration is by way of a building or residential house or flats allotted to the owner of the property. So year of chargeability, in fact, to the R.V. Ishwar committee, when this issue was there, when the government appointed, I was one person who just had an opportunity to present before him the problems relating to 247 clause 5. So one of the issues also seemed to have addressed here. So when the capital gains is chargeable tax, the capital gains is going to be chargeable tax as the income of the previous year in which certificate of completion for the whole or part of the project is issued by the competent authority. It's very important amendment. Taxability is not in the year of joint development agreement or possession. The taxability is only when the builder hands over the project or gets completion certificate from the appropriate authority. So very, very important, crucial amendment. But then the full value of consideration, this is something very interesting. This what is not what at least I presented before him. The stamp duty value on the date of issue of said certificate of his share being land or building has increased by whatever received in cash. This is going to be taken as a consideration. So therefore, stamp value on the date on which the project is going to be taken as the full value of consideration. And what is very important is whatever amount which is considered by virtue of 49 subsection 7 is going to be given as his cost. Just like what we discussed in 49(4). Whatever amount on which he has paid the tax becomes his cost by virtue of 49(7) of the Income Tax Act. So that's here, next slide. Deemed full value of consideration considered for the purpose of 45(5)(a) shall be deemed to be the cost. So logical question comes, why this section? Why this section has to be introduced? So a lot of litigations arise on account of Joint Development Act. Once the Bombay Court judgment started giving a very stunning judgment that in the case of a joint development agreement, capital gains will arise not on the possession. It's very surprising why possession becomes why. Because if you go by the Bombay Court judgment, the judgment says on the date of entering into JDA. They don't even talk about when the landowner gives a possession to the builder. The date on which JDA is signed, that is the date on which, as per the Bombay Court judgment, they set the ball rolling after the introduction of 247 clause 5. It's the date of entering into the agreement is important, not even the date of handing over the possession. On that day, capital gains arises. That's the first issue, when the capital gains will arise. To consideration for the purpose of computing the capital gains. Now, what is the consideration for the asset? I am going to get some constructed flats. Should I have to take the guideline value which is given in 45(5)(b)? Should I have to take the fair market value at which the builder sells to an outsider, or should it be the cost of construction? Fortunately, unfortunately, most of the judgments are saying the cost of construction shall be taken as the capital gains for the landowner or the owner of the property. So whether the exemption is available, because most of the occasions, as will be aware of, the landowner or building owner will get 4 or 5 flats. So whether the exemption should be given for all the 4, all the 5. So because earlier the 54 was using the word purchase or construction of a residential house, whether that a residential house should be taken as one, or should it be all. KG Rukmani in many cases which conceded the fact that so long as it is going to be the same building, exemption should be well for all. So even now all the decisions in recent times, if you see, they say that amendment is made only from assessment in 2015-16. So therefore, by and large, substantial judgments, including many Madras High Court judgment, for 54 and 54F, pre-assessment of 15-16, they are concluding that exemptions are available for all, even in 54F. So not why 54, even in 54F. So these were the issues which were there in before 45(5) has got to be introduced. So therefore I'm just also basically trying to give you a transaction as to how it happens so that you can appreciate this particular point. So assuming the property owner has got 4,800 square feet, he says 2,400 square feet, you give me constructed flats to me. So remaining 2,400 square feet of land, you construct, then sell it to an outsider. Therefore look from the property owner perspective. So he retains half of the land, just 50% of the land, on which he is going to get, so if it appears to be as 4 houses, take it as 4, if it appears as 2 houses for you, take it, that's not a problem. So in his area, the builder is going to construct flats and give it to him. He is going to get 50% of the land. In that, he will construct property and sell it to outsider. Therefore, for him, he gets 2,400 square feet of a land for nothing. But there he can construct the flats and sell it to an outsider. So in the land which is retained by the owner, there is going to construct flats. Therefore, the consideration for the property owner is the 2 flats or 4 flats which is constructed in his area. And from the point of view of the developer, he gets land free of cost, which he can construct and sell it to outsider. So then how he executes the transaction in general, without going into more specifics. So let's assume there are 4 buyers to the transaction. So the UDS transfer has to happen. So that transaction is going to be executed between the landowner and the flat purchaser. After that, the developer or the constructor enters into agreement with the person who's booked the flat, a construction agreement. So normally this is how they try to do the transaction. So the property owner has got the 2 flats. He has got an option either to retain for himself or he can also sell. So therefore, basically what happens is 50% the area I have given to the developer. In turn, I get in my area constructed flats. So therefore, the constructed flats is a consideration for me, for which I am parting with the land. So therefore, most of the assessees are taking a stand. The cost of the building which has been constructed in my land is going to be the consideration for half of the land which I have given to the developer. Therefore, I will take 50% of the land as my cost of acquisition, for which cost of the house which he built in my area is offered as a consideration, but the capital gains, as per the Bombay judgment, will have to be done on the date of JDA. So that means without having the consideration in his hands, he has to pay capital gains. There could be a possibility of delay in construction and all this stuff, but at the end of the day, there is a necessity, he has to pay the capital gains tax on the date of entry into agreement. So a lot of judgments which are there, which are given, maybe you can go through and say, give the slides. So basically what they have now done, postpone the capital gains at the time of completion of project. Instead of cost of construction, which are given as a judgment, one of the judgments is given. So Raghuram, many judgments are there, one judgment given, where the tribunal has taken a stand. Cost of construction should be taken, but 45(5)(a) says you should take the stamp valuation. So the stamp valuation will be the consideration. To that extent, department wins this point. As far as the year of taxability, I think we can say assessee has won it, because the capital gains is going to arise only when the project is handed over. Therefore, to that extent, what 45(5)(a) is trying to do is trying to balance both the sides. The assessee side, this capital gains is going to arise only when the project is over. That means the uncertainty of income is not going to be there for him. And from the perspective of the department, instead of cost of construction, the guideline value on the date of completion of project becomes a deemed consideration. And to that extent, I think there seems to be some element of balance has been restored. Now, what is very important here, in the area in which the assessee has got the flat, or suppose if he sells that flat immediately, how to compute the capital gain? That is one of the reasons why I brought the issue number 1. Now, the land is already with the assessee, right? This is his land. In that, 2 flats were constructed by the builder and given to him. Assuming that he wants to sell immediately, what is the nature of capital gains? Now, building has been constructed in my land. As soon as the possession hand over, within 3-4 months, I have sold it outside. In most cases, I would request even the builder to, land developer to even sell it off on my behalf. Now, is the capital gains short term? Again, we go back to the first issue. The land I am holding for more than 24 months. In no flat is going to be constructed within 24 months time. On which the building has been constructed by the builder, which I have sold immediately. The building is short term. So therefore, go back to the whole discussion, the first issue. Since land is long term, building is short term, there is a need to compute the capital gains separately with land long term and building short term. And more importantly, based on the Karnataka High Court judgment, the landowner, the property owner could also claim, I am going to be eligible for exemption to 54 in this particular case because of the fact what I sold is a residential house. The land portion of it is a long-term capital gains. So what I sold is only a residential house. I am eligible to claim exemption to 54 even though the building portion of it is short-term. Since the land appurtenant to the building is long-term, I am entitled to exemption under section 54, not under 54F. To that extent, I think there is a need for an amendment in the Act. Otherwise, based on this Karnataka, which looks to be a little bit logical, the assessee, even though prima facie it appears to be a short-term capital gains, is going to get an exemption to 54. That is what is most important. So I think that is one area which is definitely what the Karnataka has thrown. So in a joint day agreement, this also becomes a little bit more interesting, and that is one of the reasons why I put the first issue before coming to the 45A part of it. So just to put a small issue here is where a JDS entered in 2017, so it's going to get 2 crores and 20,000 square feet of built-up area. If certificate of completion is issued in 2021-22, the stamp duty value developed is 60 crores. So the way in which the section wants you to compute the capital gains, take the stamp value of 60 crores plus 2 crores of cash. 62 crores will be the full value of consideration, but the capital gains will arise only in 2021-22. But the only problem here, the 2 crores which has been received in cash would have been received in the first year, for which there is a requirement to take a withholding tax under section 194 IC, because whenever there is a cash component, 10% withholding tax is required in 194 IC. The TDS on this will be there in the first year, but the taxability of capital gains is going to arise only in 21-22. There is going to be a mismatch between 26 years and this, because you can claim the credit for TDS only the year in which you offer for tax. When you receive a cash component of 2 crores, in that year, as per the amended section of 45(5)(a), the capital gains will not arise. So therefore, at the time when you have the tax credit, income is not offered for tax. Therefore, there is a challenge in 199. But when the year in which it's offered for tax, the credit will not be reflected in your 26 years. So which again is a very important problem which is associated out of 194 IC. To that extent, I think, in my view, I think we should immediately, there should be an amendment. In fact, this reconciliation between 26 years could be easily avoided. I think we should have a simple mechanism where the credit for TDS should be given only in the year in which it is given. I think we should get away from the concept of the year in which is income for offered for tax for the sake of simplicity, with more and more interface is not going to be there between the assessee and the department. I think the simplest way of giving tax credit in the year in which it is there, take the credit in that year, simple. If it is reflected in that year, whether you offer for income or at the end of the day, when it's offered or not, it's the money of the assessee which has been deducted. So therefore, that makes the life simpler for most people. I think that should be the easier way of doing when you are moving for a no interface type of situation. I think that should be the simplest way in my view. I hope that the government takes this particular point and makes an amendment. And because now it is not even necessary to go to the government, because the 199 credit is now comes under the income tax rules. I think it's no more it's part of 199. So since it is there in the rules, the highest administrative authority themselves can take a call to change the current system, which again needs quite a lot of reconciliation with, again there is going to be a data collected from GST on the income tax return. GST is on due basis and a lot of people may be offering on cash basis. Again there is going to be bound to be a difference between the turnover as per GST and turnover as per ITR. So these problems I think we should resolve for an easy administration and interface. So this is one challenge we talked about. So just 2 minutes, just give me 2 minutes. So now the question is, will this 45(5)(a) apply for projects which are commenced before 1/4/2017? So there are some cases where, based on the old judgments or earlier judgments, assume SSC has offered for tax in the date of JDA. The new provision has now come and says it will be taxable in the year in which the project is handed over. Now can the department now come back and say, boss, whatever income you are offered for tax in that year is wrong. You pay the tax in this year. That's one question which arises. Will this section apply only for projects which are commenced on and after 1/4/2017, or should this section be applied for earlier years also? Already there is a tribunal judgment from Hyderabad has come, where they have taken a stand. The section 45(5)A will apply only for projects which are started after 1/4/2017. So to that extent we have to wait and see. But that is the first judgment is in this way. Say that this section will apply only for projects which started after 1/4/2017. So we have to wait and see as more and more judgments follow this. So the tax implications, as I said, if you change the cost to guideline value, all this thing could result in multiple complexity. I think the board should clarify that this new provision will apply only for agreements, and maybe they can also come back and say how to calculate the capital gains for the earlier years, maybe through a circular, which will help in minimizing the litigations further. But it appears as of now that this section will apply only prospectively and not for earlier projects. Yes, sir.
Sorry, there is a change in the guideline value.
Yeah.
Because of the government. What kind of
Sorry.
guideline value? If the government increases the guideline value
Yeah.
for the purpose of realizing more stamps, what should be the impact in terms of
No, the guideline value are never increased retrospectively. So at the time when you enter into agreement, whatever guideline value is what you're going to take. Where is that issue as such arises?
case of first receiving cash consideration and subsequently
No, see, my point is that if your question can be answered in two ways. One is, assuming that there is an increase in the guideline value not matching with the fair market value part of it, what can you do? So one is, you have an option to go back to the state government to dispute the guideline value. Alternatively, 50C itself provides for the same. So in case if you feel that you are not in a position to get the consideration mentioned in the stamp valuation, you can go to the assessing officer and ask him to refer to the valuation officer. So even though the 50C is trying to use the word, the assessing officer may, consistently the courts have held that may is not a discretionary. So the may appear in 50C is not a discretionary power. They have to exercise, they have to refer the case to the valuation officer. So therefore in that particular case, you have to go to the assessing officer, ask him to refer to the valuation officer. The may appearing there is not discretionary. So therefore he has to refer to the EO and he should ascertain the value. That will be deciding. Otherwise, dispute it before the state government. Section will not apply. 100% not applicable. Consideration will go by 45 subsection 1. No 45 by.
Sir, is the specified agreement should be registered or what?
Not necessary. Not. So this was the point which I was talking about, 50C amendment from assessment year 2019-10. And I think very honestly the wording of the section is a lot to be desired. It's not the best of the ways in which you can define, because I don't think they thought about this before drafting a section. And if you just want this one classic example of we have to really come out of this at least in the next finance side, because the section says actual consideration be 105%, then actual consideration will be deemed the full value of consideration. Now you cannot say actual consideration can be taken as deemed consideration. You could have actually said 50C will not apply. I don't think we can have such a kind of a language where the section uses the word actual consideration is a deemed consideration. They say real is a fiction. I think that is very, very unfortunate that we should have been a little bit more careful in using the language of the wording section. They convey the message, but it would have been better worded. But however, in my humble view, which I have submitted before many forums and including at the government level also, that there should not be 5%, it should be at least 15%, because earlier when there was chapter 20C, the Supreme Court in a case law called CB Gautam, the main case, why it should be 15%? Because of the fact CB Gautam case, Supreme Court, Honorable Supreme Court has said, when you had an S12 chapter 20C, when acquisition, they said up to 15% variation should be accepted. That should be the tolerance level. I don't know why they got 5%, but at least there is a beginning was made where a 5% deviation is allowed from the circle rate to the actual consideration, where 50C is not going to be invoked. And similar provisions are also made in 43CA, which is applicable for stock in trade, and 56(2), which is applicable for income from other sources. The point which I already mentioned about this earlier also. See how much time I have, so that I don't take away your time. Yeah. So I'll just skip some of this. Yeah, that's quite good. So we'll touch base on one of the recently introduced section, which is full of some element of controversy. There is no denial of the fact that 112A could have been introduced. There is no debate on this particular point. The only issue is that should we also have Chapter 7 of the Finance Act and 112A? That is the only issue. So either you go for STT route or go for taxing the long-term capital gains. So having retained STT, the question is, should I have to? So therefore, the moment you want to bring 112A for whatever reason, and STT should have been abolished, but unfortunately we have both STT as well as 112A. So that means there's a curtains for section 10 subsection 38. Now we have moved into a new section 112A to tax the long-term capital gains on listed shares and units of an equity-oriented fund. Now, in recent time, there has been some element of changes even in the holding period for short-term and long-term. So therefore, just will touch base relating to shares, at least some of them how it panned out. So listed shares, no problem for all the last 3 years or so, it's same 12 months. Now unlisted shares, we had a very peculiar point. 2014-15 till is only 12 months. In 15-16 it was 36 months. But from 17-18 it became 24 months. In fact, in my book on capital gains, what I've suggested is let's across the board make 24 months for all assets. But there's no 12, 24, 36. Let's make 24 for everything, 36 for everything, 12 for everything. If 12 for everything is definitely not feasible, go for 24 for everything, or go for 36 for everything. Now this 12, 24, 36, what is very important to note there, unlisted preference, unlisted debentures, so will come under 36 months. So too much of complication there. Whereas listed debentures will be under the category along with shares. So therefore we have this 242 has to be very, very closely seen today. So if you take the case of a units, there are multiple units many mutual funds go through. If it is an equity oriented fund, it's 12 months. If it is not an equity oriented fund, we are directly back to 36 months. There is no 24 months for them. So therefore there is a huge variation in 12, 24 and 36 months when we are talking about reducing litigation. I think there should be some element of uniformity. It's just what you do in the case of securities to have this point noted. So as far as the cost of acquisition is concerned, from assessment in 95-96 onwards, we have some kind of settling down in income tax. The original shares will be taken as original cost. Bonus shares will have a zero cost. For the benefit of some of you, before assessment year 95-96, bonus shares will also be considered as an average cost. So not at the base of zero. So right shares, if exercised, whatever amount you pay for the rights issue, and if rights are renounced, the cost is going to be taken as zero. Just for the benefit of some of you, earlier the Supreme Court followed accounting for the purpose of bonus shares cost of acquisition or right shares, where the principle is based on average cost. In fact, in the case of renunciation of rights, we must compliment the Supreme Court for going by the financial management theories and say the fall in the market value of original shares will be taken as a cost. Fantastic decision by the Supreme Court accepting accounting when there is no specific provision in Income Tax Act. Dundada by Kapadia, where the judge has made a beautiful announcement, where there is no specific provision in the Income Tax Act. We should go with the financial management where fall in the market value of cost of the original shares is recognized as a cost in income tax. To clarify beyond doubt, they just made as renunciation will have a zero cost, bonus shares will have a zero cost, rights if exercise amount paid for the rights, and original shares original cost. So one important issue which arises out of this, if the bonus shares were allotted before 1/4/2001, till assessment is 17-18, not about 1/4/81, Indian stock markets are hardly there. But that 1/4/81 when it gets advanced to 1/4/2001, one logical question which arises now, if my bonus shares were allotted before 1/4/2001, should my cost be taken as a zero, or can I substitute FMU on 1/4/2001? This issue may not have been in focus before assessment is 17-18, 1/4/81. How many people will be having shares in 1981? Just imagine, virtually it will have been virtual non-issue. But if it is 2001, it's going to be a very important issue. Now this provision of cost of acquisition given under 55(2)(a) of the Income Tax Act, whereas the substitution of FME on 1/4/2001 is given by 55 subsection 2 clause B subclause 1. Now 55(2)(b)(1), which allows you to substitute FME on 1/4/2001, and vis-a-vis 55(2)(a), which takes the cost of acquisition of bonus as 0. So now the question which arises now, should I have to go by specific provision of 55(2)(a) over the general provision of 55(2)(b)? Now if you apply this logic, the cost of acquisition should be taken as 0 even if the shares allotted before 1/4/2001. But what is very important is, if you go to 55(2)(a), the opening words in 55(2)(a) is subject to 55(2)(b). Subject to 55(2)(b), cost of acquisition of bonus shares is 0. Now what is 55(2)(b)? If you acquire any capital asset before 1/4/2001, the assessee at his option can substitute FME on 1/4/2001. Now since 2AA is subject to 55(2)(b), so I just given a note there. So if the bonus shares were allotted before 1/4/2001, there should not be any problem in taking the cost of FME as the cost. There is no need for you to take the cost as 0. So after the advancement from 1481 to 2001, this becomes a very important point. Section is very clear. It starts with subject to 55(2)(b). So 2AA is subject to section, therefore you are entitled to substitute FME in all the cases. So again, this 111A as well as 1038 both got into focus from 1st October 2004. So when STT is paid and if the capital gains is short term, then the tax rate in those circumstances, when it was introduced at 10%. Currently the section stands at 15%. No changes. Even today on 111A, you continue to have a 15% tax. Now, even though I think what is very important to understand, sometimes the way in which the law is framed is pretty surprising me. 111A was increased from 10% to 15%, and there is a bit of a logic in why it was 10%. See, the most important point what is bear in mind, in 112, long-term capital gains are taxed at the rate of 20%. Now, is there any logic behind why it should be 20%? So there is a logic behind 20%. Unfortunately, in my view, subsequent governments did not follow this logic. In assessment year 93-94, where 112 was introduced, in assessment year 93-94, the first slab rate of tax was 20%. The finance minister at that point of time, after introduction of index cost of acquisition, as some of you will be aware of, the index cost of acquisition replaced a section called 48 subsection 2, which provided for a standard deduction like what you had in income from house property. The capital gains for inflation is going to be adjusted through a standard deduction. With the finance minister at that point of time, being economists, thought it is not fair. You cannot have a 50%, 60% standard deduction irrespective of the holding period if you are trying to adjust for inflation. Therefore, he said we will introduce the concept of indexing the cost based on actual inflation, as it really faced some kind of a resistance. And he said, okay, fine, we'll also offer only a concessional rate of tax. Now, why it is 20%? It's the first slab rate of tax at that point of time. Once the rate of first slab rate of comes down, actually what any government should have done, they should have reduced 112 also to that rate. See, just imagine for a moment, I have only 2.5 lakhs of capital gains, basic exemption limit is available. Between 2.5 lakhs to 5 lakhs, if you apply 112, the rate of tax is 20%. If you apply the normal slab rate, it is 5%. Now, if you go to 112, please go and see at that point of time, it says this 20% is a concessional rate. Now, just assume for a moment, I come back and say to attend this program, the fees is 500. Somebody asked me the question, I want to attend the series of programs, will there be any concession? Yes. What is the concession? You have to pay 2,500. That's not concession. 111A when it was introduced, please go and see the rate in assessment year 2005-06. The rate was 10%. Why it was 10%? That was the first slab rate in assessment in 2005-06. But what happened subsequently? The rate of tax has moved from 10% to 15% by giving a beautiful financial management reason. Amazing reason given. Dividends are subject to dividend distribution tax at the rate of 15%. Now, typically in a financial management, what do you do? A company either decides to retain or distribute. Now, when it decides to retain, what reason is going to give? I am going to retain, I'm going to invest in further projects, which in turn will increase the earnings, which in turn will give you or increase the market value. That means in turn, you will get more capital gains. Your return from an investment is going to comprise either of dividends or of capital gains. If I don't have a projects, I distribute. If I have good projects and they have increased the earnings, then I retain. If distribution is getting taxed at 15%, retention, which is going to subsequently result in capital gains, should also be taxed at 15%, which is a beautiful financial management reason given. Amazing reason. In fact, I would have said differently. Because you are taxing the retention at 10%, please reduce the distribution to 10%. There is another logic also there, no? But the only language mistake was these are all the concession. That's the only problem. Don't say concession. Concession rate, you cannot have more tax than the normal rate. That is the only problem. So, but anyhow, it doesn't matter. But 111, even after this, all this controversy surrounding 112A, 112A continues to remain the same. If the short-term capital gains, you end up in paying a 15% tax, provided STT is paid. So please understand, in this section, they did not say the STT has to be paid both at the time of acquisition and transfer. Is not there in 111A. It is there only in 1038 and 112A. That means even today, at the time of sale, if STT is paid, you will still get this concession rate. Whereas 1038 and 112A requires both at the time of acquisition and also at the time of transfer, STT is required to be paid. So both the sections are clear on this particular point. So what is that 1038? So if it is a long-term capital gains, then it's going to be exempt from tax. Only condition required is you should pay STT. The revised condition now is that you should pay STT both at the time of transfer as well as at the time of acquisition. So you can also refer notification number 43/2017, which is also made applicable for 111A. When STT is not required to pay at the time of acquisition, it's a long notification. Possibly you can refer on account of paucity of time. We'll skip that particular part. Now exemption at 1038 is now withdrawn. We are into the new regime where 112A, where you have to pay 10% of long-term capital gains in excess of 1 lakh. So if it is 1,50,000, then you have to pay 10% of 50,000. It's not that once you cross the threshold limit, 10% is going to be applied in the entire amount. It's not like you're 56.2. As the section appears to be very clear, 10% recovered only on the excess amount and not on the entire amount. So they also provided for what is called a new terminology of grandfathering. So in recent times, definitely whether able to remember grandfather otherwise or not, at least in the last few period, we are definitely able to understand something about grandfather, because it started off with Indo-Mauritius treaty amendment where there is a grandfathering, where there India-Cyprus and India-Singapore, and now it's 112A. So I think we should thank the government for making us remembering the grandfather. What is their grandfather? So that's what we're going to see. So the first point already read, Chapter 6A reduction, like your normal long-term capital gains, not available. For a normal long-term capital gains, suffers tax in 112. 87A rebate is available. 87A is not been prohibited for that, but it's prohibited for 112A. This is interesting. You can also get the basic exemption also for resident individual and HUF. So we'll just touch upon of the what I say grandfathering, because this provision was introduced on 31st of January 2018. Cutoff is being used as a basis here because the budget is presented on 1st February now. So when suddenly we don't want a situation where retrospectively we tax something which already been exempted from tax. So therefore what they are trying to say, whatever profit which has accrued to you till 31st of January will not be taxed, for which I need to create a provision. So therefore they are saying this is really the cost of acquisition. FME on 31st of January 2018 at the highest price on that day, not the closing price, highest price on 31st of January, or actual consideration, whichever is lower will be of first step. This you have to take as compared with actual cost, whichever is higher. Now this is going to be taken as the cost of the shares which you are holding up to 31st of January 2018. If you acquire the shares after this date, no problem. Take whatever amount you paid as your cost. So the two steps is what I find is a little bit more easier than going through 112A. So the benefit of first and second proviso to section 48, that is first proviso is basically for exchange rate fluctuations. Second proviso is indexation. I think at the time of, even my friend was sharing this point also, at the time of discussion we are talking about this particular point, 112A is saying indexation is not available. 112A is only a provision which provides for tax. When the bill became an act, they understood this particular point. They also made a change in 48 itself now. where they clearly say for capital gains referred in 112A, indexation benefit is not available. So now, therefore, I don't think there is any challenge from litigation perspective about indexation. Now it's pretty clear that indexation benefit is not going to be available for 112A. So in the case of a loss, of course, they themselves clarified in the FAQ which was there, where you can set off the loss like any other capital gains, because 1038 is no longer available. So I'll just give, I don't know whether it's visible. So if, assuming that you are purchasing shares in January 2016 for 1000, FMU on 31st January 2018 is 1250. The actual sale price in August 2018, let's assume is 1500. So basically your profit here, before you even go to the 112A, now 1500 minus 1000, you made a profit of 500. Now this 500 otherwise would have been exempt from tax on account of 1038. Now suddenly I am now trying to bring a provision tax something which otherwise not taxable. So therefore what the government comes back and says, till 31st of January you made a profit of 250. That will not be taxed. Now how I bring this by way of a law? So I am saying that if you sell after 1/4/2018, instead of actual cost of 1000, it will give you a cost which will work in 2 steps. Now step 1, so you take the fair market value or actual sale, whichever is low, which is 1250. This you compare with actual cost, which is 1000. So if you take the cost becomes 1250. You have sold it for 1500. Therefore your profit is going to be 250. Whereas your actual profit is 1500 minus 1000. So which is 500. 250 is not taxed because 250 is a gain which accrued to you as on 31st of January 2018. So what this grandfathering provision tries to achieve, whatever profit you had up to 31st of January will not be taxed, which is given by way of a cost. So as you can see from situation 1, that's how it appears a cost. Now if you take situation 2, now 1500 is your market value as on 31st of January. You are selling it for 1300. Your profit as on 31st of January is 500. But whereas you actually made a profit of only 300 because the share price have subsequently come down. Your profit as on 31st January 500, but whereas 1300 minus 1000, your actual profit is only 300 only. Since the entire 500 at the old provision continued should have been exempt from tax. Therefore, in this particular case, obviously you could have easily concluded by now the capital gains taxable will be 0 because I had a 500 rupees of profit as on 31st of January, but when it is sold, I made a real profit of only 300. That means I should not be taxed at all. So which is reflected in the calculation given in 112A. The last one, 1000, 1250, 900, I made a profit of 250 as on 31st of January, but when I actually sell, there is a loss of 100. Will I get the loss? The answer is yes. So this loss of 100 can be set off against any other long-term capital gains, and if you are not in a position to set off, you can carry forward for a period of 8 years. The only problem is you will not be in a position to get the indexation benefit. So the loss will be only 900 minus 1000. So, however, there could be some advantages here. Suppose if this asset is not sold in the stock exchange, STT is not going to be paid. The moment STT is not going to be paid, 112A will not apply. The moment your 112A is not applicable, then you have to go by normal provisions. Therefore, to get the benefit of indexation, so this has to be sold as an off-market transaction without paying security transaction tax. If STT is paid, 112A will apply, where your loss will be only 100. If STT is not paid, either at the time of acquisition or at the time of transfer, so both are required, then only 112A will apply. If 112A is not applicable, you will come to the normal provisions. Once you come to the normal provisions, you are eligible for indexation. Now once you are eligible for indexation, the loss will be more than 100 also. So that is how the scheme actually works. That's what I have given as a table to understand how this 112A works. So this is another very important amendment of recent times. This is based on Murali's request. I'll just touch base on this particular point. So already have our provisions today to conversion of capital into stock in trade is already going to be taxed under section 45 subsection 2. But the capital gains and business income both are going to arise at the time of sale of the stock in trade bundle. But what will be the position if a stock in trade is converted to a capital asset? Say for example, if you are a person in the business of real estate, you have land as a stock in trade or your house as a stock in trade. This you want to move to the investment. When you move your land as a stock in trade, 45(2) will apply. But both capital gains and business income will arise only when the stock in trade is sold. The difference between fair market value and the date of conversion minus the cost is capital gains. Final sale minus FOB is business income. But there was no provision in the Act to handle the reverse. So now in this particular case, what they have done, they made a beautiful amendment to the definition of income, section 28 and all this stuff, where today when you move your stock in trade to investment, at that point of time itself, income from business will arise. Let's assume in your books you are carrying the land at 10 lakhs. You move it from stock in trade to capital asset and the price, the fair market value is 1 crore. Now the difference between 1 crore and 10 lakhs will be assessed as income to business. To that extent, it directly conflicts with the provisions of the reverse. In the reverse, you have to pay both capital and business income only on the basis of realization. But here, when you move from balance sheet, from your stock in trade to your investment, at that time capital gains arises. And that means you have to pay tax on an amount which you have not realized immediately under business income, which could also attract a 30% tax plus. Now what will happen if you subsequently sell the investment? The difference between the market value and the consideration will be subject to capital gains. The indexation benefit or long term or short term is only going to be taken from the date on which you have converted the capital asset, not from the date of acquiring the stock in trade. So therefore the capital gains arises at the time of realization, but business income arises immediately without even realizing the amount. It's a very path-breaking change, especially when the real estate or was more possible, very common in both real estate as well as in shares and securities, because even the board circular allows you to have partly as stock in trade, partly as an investment. So when you do this, this is a very important change which is made, and this will have a far-reaching implications. For one main point here, as soon as you change your nomenclature, business income gets triggered without even have to realize. There are a lot of provisions are there. In fact, the two more speakers are there. So I think it's unfair on my part to really just make them listen to my speech. That is even more unfortunate. So therefore, I thank you all for your patient hearing, and thank both Murli and Abhishek Murli for giving me an opportunity.
I request the other speaker, Dr. C.A.V. Murli, to present a memento to Mr. T.G. Suresh. Thank you, Suresh sir, for such a threadbare analysis. The next topic is income tax appeals, and for want of time, I shall keep this short. Now, given some of the most recent developments that we have seen, some of which have been mentioned by the Honorable Principal Chief Commissioner as well, we have to take into consideration that there is going to be a dynamic shift in the entire income tax proceedings. As the Principal Chief Commissioner mentioned, today the e-filing portal has completely changed. Earlier we were using it only to file return of income, maybe request for intimation, add an auditor, add CA, maybe file your tax audit report. These basic things were only being done. But in the last 6 months, two major changes have been made. One, it is an introduction of e-assessment proceedings. E-assessment proceedings. Now, what is this e-assessment proceedings? While earlier, we had to go face to face with the auditor and with the assessing officer. Now, this entire interface has been cut off. The second major change is jurisdictional assessment has completely been changed. You might have had a client who's based in Saukarpet. Normally your ward will be in BSNL building. You will meet the assessing officer and you will present your case. Now, there's going to be a no-place assessment, which means that same assessee who was in Saukarpet now can be assessed in Mumbai, Delhi, Chhattisgarh, Raipur. You don't know. It is going to be picked at complete randomness. So this is a revolutionary change, and what is going to happen is that it is likely that the entire rapport that an auditor or an authorized representative shared with the assessing officer has been disconnected. The face-to-face has been removed, which means it is going to shift, at least in the opinion of the income tax, from a subjective assessment to an objective assessment. And what is the possible challenges which are involved in this? If it was an assessing officer here, he posts the hearing for, let's say, today. We go meet him. He says, "Sir, you wanted the confirmations. I don't have it today. I will get it tomorrow. Sir, can I come tomorrow, sir?" He will say, "Okay, Pa, you come in the evening after 5 o'clock. I'll finish all the rest of my cases, then you can come and give it." But if it is shifted to an online portal, it will become a slot system. First, slot must be available for you. Second, slot must be available for the assessing officer. So if these both are not there, you cannot say, "Sir, tomorrow I will give information." You have to fill everything in a box which is like an email. Furthermore, presentation ready. Furthermore, what will happen is you will have the challenge of logistics. Practically, when the file is based out of Chennai, from an income tax point of view, is it going to be easy for them to send it to wherever the jurisdictional assessing officer is based? Is it going to be easy for you to translate the information? The submissions that you make to an assessing officer ranges from 1 page to several hundreds of pages. So does the income tax expect you to scan each page and then upload it? And even if you scan, upload it, what is the guarantee that everything is visible? We know that quality of scanning sometimes can go wrong. How will this person communicate the visibility of it? Especially when it comes to time-barred assessments. And we all know that the time limit for assessments has been reduced. It has been reduced in the last few years. And with this, already orders are being passed in a very rushed manner when it is close to the deadline. Therefore, e-assessment proceedings, how easy is it going to be or how challenging is it going to be? I expect, at least in the first few years, we're going to have several teething issues, which means there's going to be a lot of adverse orders which are going to be passed against assessees. That also means a lot of opportunities for us in terms of appeals. So the only recourse that we have to rectify this sort of challenge is through appeals. Now, the brief definition of an appeal, as we all know, like in a cricket match, an umpire refers to a third umpire for a better opinion. The appeal means you are referring the issue that has been resolved to a higher judiciary authority to review or reconsider the order of a lower authority. Now, this higher authority obviously is someone you have to go on appeal under the Act. So what does this mean when I say we have to go on appeal under the Act? Your right to appeal is not a right that you just have. It is not a substantive right. It is not an inherent right. It is a right that is prescribed by the Act. Therefore, we can split the entire income tax proceedings into 4 stages. The first stage is obviously the assessing officer who passes the order. The next stage is the Commissioner of Income Tax Appeals. Then you have the Income Tax Appellate Tribunal, which is the final fact-finding authority. And finally, you have the High Court or the Supreme Court, but they will only take matters that have substantive question of law. We shall start briefly first on the CIT appeals. Who is he? What are his powers? When can we go to him on appeal? Now, Section 246A of the Income Tax Act specifically mentions what sections on which you can go on appeal to the CIT. Therefore, if you want to go on appeal on a matter that is not specified in this exhaustive list, then you do not have a right to appeal to the CIT. Therefore, it is very important that you understand Section 246A and you read specifically what are the sections you want to go on appeal before you go on appeal. Because otherwise it is possible that the appeal will file flat on its face and it will be dismissed. There are certain basic forms that need to be submitted in the CIT appeals. Form 35, a statement of facts, grounds of appeal and a challan. Naturally you have to give the challan, otherwise they won't hear. So what are the statement of facts and grounds of appeal? Statement of facts will be a very detailed form which will detail right from the time you file your return of income till the completion of assessment. What are the details, what are the issues, what submissions you made to the assessing officer, maybe case laws that you wish to rely on. Make it very robust, make it very complete. That should come out in your statement of facts. Your grounds of appeal, on the other hand, is the complete inverse of it. It has to be very short, it has to be very concise, it has to be bulleted, and it should only cover the main dispute. It should not go into facts. Therefore, these are some critical points. And why it's critical at this stage, I will tell you. The proceedings at CIT appeal are, let's say, it is somewhat informal. The reason why I say it's informal is because the Commissioner of Income Tax Appeals is very much a part of the department. He was probably a person who held assessment charges before. So he is more understanding of what are the issues that are faced by the assessee, what are the issues on record by the assessing officer as well. But the next level is the Income Tax Appellate Tribunal, which is established by the Ministry of Justice. It is not part of the department. The circulars, notifications, everything by the CPDT are not binding on the ITAT. Therefore, when you draft your statement of facts and grounds of appeal, it is very important you have a futuristic view on doing it. And this is precisely why drafting of appeals and going on appeals is an art and it's not a science. There might exist a format, but it is not enough if you follow the format. You must also know when you should follow the format, on what particular matters you should bring on appeal and what you shouldn't. The procedure of the CIT appeals is normally it is done in a closed room. Like I said, it is something, he is a person who is very much part of the department, and normally the law says that the ITO should also be present in a hearing, but we all know practically it never happens. However, if required, the CIT can always call upon the ITO, he can refer an issue to him and request him to go into the specific matters if required. He also has certain powers which are very wide ranging, and I'd say the CIT is actually more powerful than the ITAT. Now why, you may ask? There are some basic powers, which is maybe condonation of delay. You have to file the appeal within 30 days from the date you receive the assessment order. So he has the power to condone the delay if you file it after 31 days or 32 days. He has the power to cure defects. Maybe the signature was not clear, signature was wrong person signed it, you missed to attach one document, things like that. He has the power to cure defects. He has the power to admit additional evidence. I will come to this point a little later. And he can also admit additional grounds if required. Now the one power that is very specific to the CIT is he does not have the power to set aside the matter. Till 2003 he had this power, and then the act was amended. It said that the CIT can no longer remand the entire matter to the ITO. He can only ask the ITO for his opinion or to inquire on specific matters. But the bigger power is the CIT has the power to enhance your demand. So let us assume your assessee has received a gift from his grandmother of rupees 10 lakhs. You have a will, the grandmother is no more. She has given it by bank transfer only after her death. And despite this, the assessing officer says, no, I don't believe you. I am going to assess it as income. So you give all the documents to him. You produce all the will, you produce the gift deed, bank statements, everything. And he says, okay. Based on this, I am going to add 6 lakhs. 4 lakhs I think is okay, but 6 lakhs I am going to make an addition. So he adds 6 lakhs. You are of course very disappointed. You go on appeal. And at the time of appeal at CIT, what happens is, CIT says, oh, he's only added 6 lakhs, is it? Okay, let me add the balance. So you are actually at a worse off position, and the reason is the CIT has the specific power to enhance your demand. There is a very interesting decision on this. Rai Bahadur Hardut Roy, which is 66 ITR 443, where the Supreme Court observed that when it comes to a CIT appeal, the CIT always has the larger interest of the revenue at heart and not just the assessee's interest. Therefore, when that's the case, he must consider the entire matter as a whole, and assessee cannot complain that he is worse off. Now, the tribunal on the other hand does not have this power to enhance. Hence, you may not be at any loss or any defeat by going to the tribunal on appeal. But sometimes when you go to the CIT, it makes sense to be a little bit more strategic. I have attached the form 35, but I will not go into detail. One thing I'd like to point out is now everything has been made online. Even when you have to go on appeal to the CIT, you have to file your form 35 online. And your grounds of appeal, statement of facts, everything has to be uploaded in that specified format that they have given. Certain important points, condonation of delay. As I said, the CIT has the power to condone your delay. You have to file the appeal within 30 days from receiving the assessment order. If you file it after 32 days, can he condone? Maybe if you file it after 1000 days, can he condone? So what is the limit? Is there any limit at all? There's no such limit actually. The Act does not prescribe any limit. It just gives them a power to condone. And that means I have seen specifically cases, not just at CIT, even at ITIT level, where even after 1000 days delay, it has been condoned. But there's a reasoning. They have to see whether there is a sufficient and just cause to condone the delay. What may be a sufficient and just cause? For example, maybe an assessee was seeking relief under some other section, maybe 154, maybe he was trying to seek relief under some other section of the Income Tax Act. And this delayed, this entire process took 2 years, 3 years, and therefore he missed the deadline of 30 days to file the appeal. That can be detailed as a reasonable and just sufficient cause. But suppose he has prepared all the documents, he is ready for appeal, but he just sleeps on it, and then after 1 week, after the 30th day, 37 days, he goes and files the appeal. In these cases, it can be rejected for negligence. It will be held that the assessee was negligent where he had prepared the documentation but had no reason to not file the appeal. Therefore, condonation of delay is a very powerful tactic, but it is something that is subjective. So you must take a call how to, preferably you always file it within 30 days, but if it goes beyond 30 days, always have a sufficient reason. The principal commissioner is not here, but so I can mention some good reasons, which is like staff was absent, he left the job, auditor made a mistake, lawyer made a mistake. That is a good reason that's normally given for short delays. Additional new evidence. Under Rule 46A, which is a very important rule, it states that no assessee can submit any new evidence that was not submitted prior to a lower authority. Which means, when you go on appeal to CIT or ITAT, it is expected that all issues that you are on appeal, all evidences that you are on appeal, you should have submitted the same evidences to either the assessing officer or the CIT. Now, when you do this, and if you fail to do this, do you have any recourse or any remedy? Yes, you do. There is a petition to file where you can ask the CIT or the ITAT to consider additional evidence that you may have at hand. There is a format that you have to follow, and normally, practically it is allowed. On legal basis, the CIT normally has the power to reject such additional evidence. Of course, the basic logic of natural principles of justice is that the AO should also get a chance to review such evidence that you are submitting additionally. Stay of demand, and this is something which is very important, and I have to cover this. because we have all seen the action that happened in March. So many people suffered, so many assessees, their bank accounts were frozen, high-pitched orders were made, and they were asked to pay 20% of the sum of money, saying only then we will stay the demand. Now, stay of demand, why it's important is you have that 20% sum of money, but if you don't want to pay that also, you can go and ask for a stay. You can ask for the stay to the assessing officer, and most likely it will get rejected at that stage. Then you can ask the same stay to the CIT appeals. And what does this mean? Why this stay power is so important at the CIT appeals? See, what will happen is, I filed for a stay petition against my demand. The CIT rejects it. What are the implications? Can I go on appeal against this rejection of stay? I cannot. The Act does not permit you to go on appeal against a rejection of stay. That means, between the time there is the rejection of the stay by the CIT until the conclusion of your proceedings of appeal at the CIT level, the assessing officer or the income tax can demand the sum of money from you. The only time you will have any recourse or remedy is when it goes to the ITAT, where you can again apply for a stay, but that you can do only when it gets posted for hearing at the ITAT. Therefore, what is the meaning? What can we do? It is almost like a mercy petition, because you are at the mercy of the CIT, who has to take your stay petition. If he rejects it, that's it. For the next 2 years almost, you have to just wait for the appeal to come to the ITAT. Is there any solution here? Now, a normal suggestion is, in these sort of circumstances, where you feel it might get rejected, the ideal plan would be you also, along with the stay petition, submit a petition for early hearing. When you submit a petition for early hearing, it shows two things. One is it shows that you're prepared, you're ready for the appeal. Therefore, even if it's posted early, it shows you might have a prima facie case. Therefore, the stay might be allowed. The second more important thing is, if it is posted early, he can reject it, he can dismiss it, at least you can go on appeal to the ITAT quickly. So, these are the two important reasons why you should plan your stay application. Important questions, as I just discussed, the stay was the first one. The second very important one is, a lot of people have asked me, should an assessee be told to buy peace? Very often in the course of proceedings, what happens is the assessee says, oh, this is too much for me, what I will do is I'll buy peace, sir, I will surrender the income, like this he'll say. So they will add the income and they'll go. So a lot of questions have been asked. So when the assessee says that he surrenders the income, can he go on appeal against the addition made? After all, he is the one who has surrendered it. Oddly, in the income tax proceedings are concerned, he can actually go on appeal against it. There is a rule called the rule of estoppel, which stops the person from saying he made an earlier submission. He cannot make an alternate submission. He cannot blow hot and cold. But this rule of estoppel is not applicable for all revenue proceedings. Hence, an assessee can go on appeal against something where he has bought peace. But let us see the practical side also. There have been times where the income tax have come and said, what is this concept of buy peace? The income tax department does not sell peace. So this entire buy peace concept does not exist. But at the same time, there are also decisions by the Supreme Court in Meenakshi Mills where they have stated that if an assessee surrenders an income or he buys peace, then in that case also the assessing officer still has to go into merits of each issue when he makes an addition. He cannot blindly say that the assessee has surrendered, therefore I am adding the income. He has to go into the merits and he has to say that so and so reason is why I am adding the income, not just because the assessee has surrendered the income. Can a new ground be raised in an appeal? Yes, it can, but there is a format to be followed where you raise the new ground. It is at the discretion of the CIT if he wants to accept it or not, and he has to feel that this new ground is reasonable when you are raising it. For example, maybe you didn't have certain confirmation, certain details at the level of the assessing officer. It has come to light subsequently, therefore you are raising a new ground based on this new information. That will be considered reasonable. The next level is the very important level of the Income Tax Appellate Tribunal. And why this is so important, why it is so different from the CIT, is because it does not form part of the income tax. It is set up by the Ministry of Law and Justice. Therefore, It has its own rules, it has its own procedures. The income tax is not binding on it. Therefore, it is completely independent of the income tax purview. It only looks at the law, the act, and persuasive measures from the CBDT notifications and circulars. And it's on a side note, in the tribunal, it is mostly represented by lawyers I have seen. Since I go regularly, there are not enough chartered accountants that appear at the tribunal. And my feeling is that chartered accountants are actually closest to the facts of the case. We are the closest to the facts of the case because we handle it right from the time of planning the income, filing the return of income, assessment proceedings, CIT, various appeals that happen in between. When suddenly when it comes to IT-80, there is a fear that it is handed over to others. But honestly speaking, as long as we keep with the act, the knowledge of the act, knowledge of the rules, we are set. Because as far as the facts are concerned, nobody knows it better than us. Now, we have to go on appeal to the IT-80 within 60 days from the date the order is passed by the CIT appeals. And just like the CIT appeals, under section 254, you have specified under what sections can you go on appeal against them. Therefore, only against these sections can you go on appeal. There are certain interesting additions as far as the appeal to IT-80 is concerned. Section 263 or section 264, when it's initiated by the side of the department, then you can go on appeal against that. You can go on appeal against reassessment proceedings directly to the IT-80. So certain additional provisions are there where you can directly go to the IT-80 by bypassing the CIT when it comes to an administrative commissioner. The form of an appeal, it is necessarily more robust than CIT appeals. You have to file form 36, grounds of appeal. There's no statement of facts that's required in the IT-80 is concerned, no new statement of facts you have to give. If you wish to change your grounds of appeal and modify them a little bit, you can do that and file it at the tribunal. You have to of course pay an e-payment challan, and it is much more expensive at the tribunal, which goes up to rupees 10,000. As far as CIT concerned, the maximum limit of the fees you pay is 1,000, but when it comes to the IT-80 is 10,000. I guess that is the fee that you pay if you want an objective assessment by someone who's outside the department. You also have to give the order of the CIT appeals, the form 35 that you filed to the CIT, the statement of facts there, and of course the assessment order of the AO. This is an actual picture of the tribunal. I didn't take this photo, I found it online. I was in the proceedings. What is happening is it's an open court, and this is probably what is most daunting for chartered accountants or other people to appear there. And you will be arguing openly in the court in front of anyone. Anybody can come, even journalists, especially if you have seen the Google case and soon to be heard the Flipkart case. You will find a lot of journalists actually come and sit inside the courtroom and they listen. They call the Income Tax Appellate Tribunal a quasi-judicial body, but friends, I'd like to submit it is not just a quasi-judicial body. For all practical purposes, it is run like a court, which means you have judges who sit on that elevated platform there. You see in the second picture behind, that's an elevated platform. The judges only sit there, and it's an open court where anybody can come and sit and watch you argue. You will be arguing for the assessee side, and there will be a departmental representative who will be arguing on the department side. And the judges will consist of one accountant member, usually of a CA background or an income tax background, and a judicial member who is usually of a legal background or who has been a former judge at any high court or supreme court or district court. Now, what's interesting here is the open court is very daunting. There is an art involved in appearing at the tribunal, because if you take the Chennai tribunal, you have 8 to 10 judges here. The constitution of each court, you don't know. It will be announced only at the starting of the week. So, your case might be posted on a particular date. You don't know who the judge is coming to, unlike the CIT. You know who the CIT is. If it's posted to CIT 8, CIT 8 is not going to change unless he gets a transfer or some other reason. It is likely going to be the same person. As far as the IT-80 is concerned, you will be given a hearing in D-Bench on 15th of June. If your hearing is on D-Bench on 15th of June, you won't know from the start who is going to be sitting there on 15th of June in D-Bench. This announcement will come at the start of the week as to who are the judges and what is the constitution. Therefore, you must be fully prepared. Maybe your appeal is part heard, maybe it's been adjourned. In these cases, you may not get the same judges again. Therefore, there needs to be a practical planning involved, a strategic approach when it comes to the tribunal. And the reason I say this is because while the order of the Supreme Court is binding on all tribunals across India, only the order of the jurisdictional High Court is binding on the ITAT, jurisdictional ITAT. Therefore, if you take the Chennai Tribunal, then the order of the Chennai High Court will be binding on the Chennai Tribunal and the Supreme Court also. Now, one of the important questions that I have raised, and you will come across it later, is, and very commonly asked, we go on appeal against a certain matter at the tribunal. There is a judgment by the Bombay High Court on the same issue, which is ruled in favor of the assessee. On the same issue, exact same issue, it is ruled in favor of the assessee. So in the course of your proceedings, you make the submission. And of course, in the ITAT, you have to refer to all the judges as your lordship, you have to bow to them, and you have to be very courteous, things like that. So you make the submission saying, your lordship, this decision has already been given in the Bombay ITAT, it is in favor of the assessee. Now, this is not binding on the judges at the Chennai Tribunal. They can reject it outright if they want. The only the judgments they have to follow are from the jurisdictional High Court. And sometimes, actually speaking, they should follow the ITAT Chennai Tribunal judgments also. But very commonly, there are judges who don't follow the same coordinate bench what some other judges in the same jurisdiction pass. Because some judges have their own opinion. They have a different opinion on the same issue. They get transferred from some other ITAT somewhere else. They might have passed an order in that ITAT based on one particular decision, so they want to carry on consistency purpose. So they pass on the same judgment here. Sometimes they change their judgment also. Therefore, when you go on an appeal to a certain bench, it is important to strategically plan it. If you give a certain judgment that is against what this judge likes or what he believes in, your appeal can be lost. So winning and losing at the tribunal is not only a matter of knowing the law, it is also knowing the art of appearing in front of certain specific judges and how they are, what their moods are, what kind of judgments do they like, who they don't like. So a lot of these very, very tidbits are very important when you're appearing. It can make or break a case. The practical procedure, as I've already discussed some of them, you have to salute to the members of the ITAT, which means not only in the court, if they're walking next to you also you have to bow to them and all kinds of procedures are there. You have to also refer to them as your honor or your lordship, and only specified people can appear under section 288 of the Act. And the reason this is important is because when it comes to assessment, AO and CIT proceedings also you have the same rule, but it is not followed very strictly, because the AO and CIT are rather familiar with how people appear. It does not mean just because they don't have a power of attorney, doesn't mean that they are not from the organization. You have that familiarity. But when it comes to the ITAT, they're very particular on this. There are many times where they ask, who are you? How are you representing the assessee? And on the spot, they will look at the section 288 and say, show me which person you are as per this provision. Therefore, if you do not have a power of attorney, and if you are not authorized by section 288 to appear, it is again possible that your appeal might be dismissed. And friends, this matter is very serious because it's the final fact-finding authority. To have your appeal dismissed on a frivolous ground like this would be very sad, because even the High Court or Supreme Court would not entertain this. You have to go on a writ appeal to them, because they only deal with substantial questions of law. So this is very important that we follow these basic procedures, and if we cannot, we should definitely refer it to someone who is an expert in this field to handle it for us. There is also a dress code which has to be followed, which means a suit, actually a black suit with tie, black shoes, which is what prescribed for men. For women, they should wear sari or traditional clothes or formal clothes, but with a black coat or a black blazer. And this also is something which I've seen, where people who have come with a coat but not with a tie, the judges have got irate and they've actually said, no, we're not going to hear the appeal. They adjourn it or they even dismiss it. So these sort of situations happen. This might seem like a very, very basic submission. It might seem a formality that you have to do this and you have to follow this at the ITAT, but it's absolutely serious. The judges take it very seriously as well. Now, the powers, as most of us, I have already covered them when I was discussing CIT. The one important power is the ITAT does not have the power to enhance your demand. that means no assessee can be worse off when going on appeal to the ITAT. Therefore, if you have a case, you can be rest assured, you can confidently go on appeal to the ITAT. You will know that he cannot pass an order which is more adverse than what is done to the CIT. The worst he can do is he can remand the matter back to the ITO or CIT with certain directions saying, please examine this further. Points to remember, I've already specified the dress code, but the first one is if there is a delay, maybe there's a certain delay or you want to submit certain additional grounds or maybe additional evidence, it is very strictly required that you get an affidavit in the whatever format is as prescribed, because if you do not do this, again this might be rejected on the very basis of it. Important questions, and I might be going fast, but due to paucity of time I want to do that. Important questions, that is, first is paper book. We are all aware when it comes to the tribunal, preparation of paper book is very important. And why is this important? It has to be numbered, it has to be serially arranged, it has to be tagged so that it can be easily referred to. Why is the paper book important? The reason I've happened to move quite closely with certain ITAT judges, so at that time I asked them, how important is the paper book? Because a lot of people spend so much time in compiling this paper book and submitting it to them. But what we have to realize is, they're humans, end of the day. And it's very important that you do not tick them off. As a very famous saying goes, you can lose the case but you can't lose the judge. You can lose the case but you cannot lose the judge. So preparation of a paper book, the judges sit for a minimum of 20 to 24 cases every single day. Every single of these 24 cases will have paper books. They do not practically expect the judges to read every single page of these paper books. And we all know our big four friends, they bring big four paper books for each case, it will be this size. And the judges get irritated. I've seen cases where the judges have just thrown the paper book at people also. So does that mean you should go without a paper book at all? No, it's a very strategic move how you want to go for the paper book. You prepare the paper book preferably as minute and easily referable as possible, and make sure whatever key points that you are referring to in your appeal and you think that need to be referenced in the order of the ITAT, you must make sure in the course of your proceedings you refer to them in your paper book. I cannot give a 500-page paper book and then when the ITAT passes an order adversely against me, go on appeal or go on review of that and say that, no, how can you say that? It's there. You see page 423, it is there. In the bottom part I mentioned that. How can you say that? How can you dismiss it? Now, there are times where the ITAT will recall this matter, but more often than not, the view that is taken by the judges and the ITAT in general is that if in the course of proceedings of the appeal, if you fail to reference that certain page of the paper book, then that means you have not submitted it at all. That is a stand taken by judges. However, there are still some people who are more liberal and they allow it to be recalled. But it is important that you reference the paper book correctly during the course of appeal. What if the order of the tribunal is wrong? Under section 254(2), you can go on a review petition, which means you can ask the same judges who passed the order to review their order. For example, some example would be, maybe he has disallowed 100 rupees. By mistake, while printing the order, he says disallowance is of 1 lakh. Then naturally, your final fact-finding authority is over. What do? You cannot file a writ for this. So you can file under section 254(2) with the ITAT itself. So judges will recall their order and they will review it. The Bombay Tribunal given a different judgment, this I have already discussed. And what if there is new evidence or new grounds? It is just similar to the CIT proceedings, where you have to file a petition under section 46A to admit the new evidence or the new grounds. The assessing officer or whoever is the department representative will be given an opportunity to cross-examine you and cross-examine this additional evidence before they pass an order on it, or this can be heard on appeal. This is a snapshot of the entire discussions that we've had, and in one table I've tried to put what each section is that you go on appeal against to High Court or Supreme Court or CIT or ITAT. What are the fees that are involved and under what sections you can go on appeal. Due to want of time, I will not go into detail of the revision powers that exist and the authorities. So I will feel free for the members to get in touch with me, and I can send the presentation to you. It will be easier for you to access this information. And thank you very much for your time and hearing this presentation. We will wrap up the presentation because once there's a story where a speaker, he stood up and said during the presentation, he was like, what time is it? How much longer can I talk? Somebody in the audience stood up and said, you can talk for however you want, sir, but we'll all leave by 8:30 like that, he said. So because of this, I'd like to wrap up this presentation here. Thank you so much for every single member who have come on a working day and filled out the hall with such enthusiasm. Thank you for staying all the way here. I'd like to thank especially the staff of SARC who have been running around getting chairs for people, who have been doing this at short notice. Literally 3 days we have done this program. We thank TG Suresh sir to come in such short notice and give such a rousing and wonderful nuanced presentation. Cancelling the class. He has cancelled the class to come here. And thank you so much, sir. Thank you very much. Have a wonderful evening. Thank you.